that music was because Rich was so excited to start the show on a Monday morning. You were trying to talk to Monkey Man. I was trying to find out. Primate Pal, welcome to the show.
Yeah, we've got a whole bunch of primates still carried across from Friday, haven't we?
Yeah. I haven't seen, what was the other one that we had?
Chimpanzee chat.
Chimpanzee chat. How was your weekend?
It was, yeah, a lot of monkeying around. There was, so Friday, relatively quiet. Went and had a look at some Black Friday sales. Didn't buy a single thing.
Not even those trainers that you sent the picture to me?
Not even the trainers, no.
I got suckered in to that's why I hate Black Friday. There are these adverts, and then I go in. Of course, the one thing that I actually want is not in the sale.
Which was
a Japanese sushi knife for a wedding present. And my friend is German, and of course he wanted Japanese steel. So I managed to find it, but it was not in the sale. So I have to say I feel a bit lighter in the pocket.
So that was your Friday afternoon. And then, yeah, Saturday, fairly, let us know what you did, because it sounds like our weekends were fairly boring. So probably a lot more interesting things to hear from the likes of Monkey Man and Dave. Dave's in the chat. Dave and Gavin.
Hey, Gavin. Haven't seen you for a while. Gavin's been with us before. I'm quite sure of it.
Absolutely.
So lots happened overnight. We're now in December. November was quite good. I thought was stellar for the November that it was, with a presidential election to boot.
The best month of the year so far.
I know, right?
If you're in Europe, if you're French, not so much. But we'll go through those shortly. Also coming up on today's show, we have Pega in teaching Pega to trade today. We're going to be starting on options. So we've gone through the stocks, we've gone through running pairs trades, we've gone through hedging, we've gone through stops and take profit targets. Now we're getting on to options. So that's going to be this morning at 8:45. And then I think you have a specialist in the area of technical analysis on, don't you?
Axel Rudolph himself. On the chat box, I've already mentioned, please, if you have any questions whatsoever, please put them here. We'll get them asked when Axel comes on. Very excited about Pega segment with you, because I'm a beginner in the option space too. So I'd be very, very keen to learn anything from there. Monkey Man saying Microsoft, Apple looking interesting. Monthly chart for Tesla on the monthly needs closer inspection.
Yeah, Friday was a bit of a markup, as it always is. 100 points in fantasy football. Hang on a minute. That is breaking news. That is 100 points. Right, I'm going to have to get mine up and show you mine in a bit as well, because it definitely wasn't hitting 100 points, Monkey Man. Well done for that. Who did you have in the team? It must have been Saka? Oh, of course, it was 5-2. Well, that was my Saturday afternoon. I went to see Gladiator 2. I actually had a really interesting Saturday. I completely forgot. I thought it was really good. If you haven't seen Gladiator 1, then it's pretty much the same storyline. There is a bit of that in it. That's right. So it's definitely worth watching. And if you haven't seen Gladiator 1 for a while, then it's also worth watching, because it's a sort of updated version. But yeah, really good. But then left there and went to the George, the pub called the George.
Yes. Is that the one?
North of Oxford Street. And yeah, met my friend Nihao, who's a fund manager, ex-millennium in the city, and we had a great chat about the way the world is at the moment, but also watched the Arsenal game and the Irish rugby game.
Nice.
So it was a great. So yeah,
a lot of football.
Met for one drink and it turned into 4.
Wow. Wasn't dull then? You had a lot of sport.
Yeah. Yeah, exactly. A lot of sport in the pub, bit of gladiators, and then came home to see my fantasy football team not reach 100 points. So yeah.
How many points did you get?
Well, I'm going to have to look up now, because I haven't actually checked.
Terence is asking.
Let's see. Make sure I don't show you all my login, or you'll all be changing my players. But yeah, very much looking forward to next season, when we can start our own Trade Live with IG, Fantasy Football League. Oh dear.
Everyone's like, oh.
Incorrect. Why am I getting incorrect password up there? What have I done?
I am very pleased to be here actually, because my weekend was absolutely rammed. So Advent, the start of the December.
Oh, did you get an Advent calendar?
No, it's just the fact that the liturgical calendar just, right? And so 4 hours of rehearsals, 2 hours on Friday, 2 hours on Sunday, performances till 9 p.m. last night, Handel's Messiah, and possibly St. Paul's again.
Wow.
Later this year, so it's a bit full on. I was talking to Chris Beecham today, who plays the organ.
Does he really?
Yeah.
That is breaking news in itself.
And we're trying to pinpoint whether we have performed together in the past, but just not known that we were both in the same theatre or same church. But yeah, this is a busy season. Everyone looks forward to the December season. I kind of slightly brace for action.
Apprehensive.
Yeah, it's good. It's just really busy.
Well, this week, because of course we have the IG Christmas party on Friday night. So thank goodness it's a Friday. Can you imagine trying to come into the show on a 5:30 a.m. after the Christmas party? That would be very unfair. So we have that on Friday evening. So
what time does it start again? Is it 6?
I don't know. You can't tell anybody where it is. Everyone will show up. We'll have all the primates, non-human primates.
They only let humans in, by the way. Monkey Man, we haven't got a picture. Monkey Man, we haven't got a picture from you yet of your trading setup. Speaking of which, tons.
Go on then, overnight action. Right, so let's run you very quickly through the performances in November before we get on to a new month. The best performer of the lot was the Dow Jones Industrial, so up 7.5%. Then it was NASDAQ up 6.2%, the S&P up 5.7%. The FTSE and the DAX were both up about 2%. It did not feel like the FTSE was up 2% in November.
No. But
I don't know where that was eked out from. And then, the big loser, of course, France, with all those political issues. France was down 1.5%. So a huge underperformer there. And yet, going into December, that is interesting. For the S&P to be up 5.7%, can it really kick on and have a Santa rally?
It's looking difficult, isn't it? So I was just talking about the city panic euphoria. This is a model by Citigroup. If you whack up my screen, I'll show you what I mean. This is a market sentiment model. Basically, every time we have a reading over 4, it has brought us a correction. We're now at around 3.46. Lots of people wondering, where are we? Close to a correction. We keep calling this, but Axel, Chris, everyone, the gang saying, don't try and stop a car driving at 250 miles an hour, which, it still gives me jitters whenever I think of Axel behind the wheel on an Autobahn. But look at the investors' intelligence chart as well. This is bulls versus bears, and we're looking kind of really overheated now. Also, interestingly, over the weekend, did you see this story? The Korea looking to invest $10 billion to boost their chip manufacturing amid this global tech race. It also comes in a really, really interesting time because obviously Trump and his new bunch of people in his cabinet looking bunch of people, no rhyme or no reason. It's every time he unveils a new member of his team, it's yet again something quite spectacular and left field, right? Let's be honest. So it also comes in a time when it looks like their semiconductor industry is going to get whacked by these tariffs. But also, Korea has long been trying to ensure that it's been shifting its semiconductor manufacturing away from places that have that relationship as well. So it's been trying to move to places like India, to places like Thailand, so that it does not get ensnared in any sort of tit for tat or retaliation with China?
Right, so I would say, well, first of all, let's do the all sessions because you'd be forgiven for completely forgetting that the US was open on Friday afternoon. So that was Tesla up 3.6%, Nvidia up 2, regaining some of the week's performance there. And then we had some moves in the tier 2 names, I like to call them as well, although Taiwan Semi was up 2%, which is a decent move. The losers, however, were Airbnb down 1.5%, American Airlines gave up 1%, and then GameStop down 6%, which I think GameStop reports numbers this week.
Yeah, I think you're right.
Coinbase down 5% as well. So that was the weekend that was. But the biggest news this morning is, of course, the Stellantis chief behind this Luton van closure has quit. So now, Ange, you've met them both. Tavares and Carlos Ghosn, haven't you? So what do you think of this story?
I think it's been a long time coming, right? Its share price has been languishing, down some 40%, right, so far this year. Am I right in saying that? My memory is a bit hazy after 4 hours of rehearsals this weekend. But also, the fact of the matter is, the board hasn't been happy with Tavares for a long time. Carlos and him, initially he was the golden child. He was the shining star. He was the, great deputy. But then remember that comment? Do you remember that comment?
What was that comment?
So when Tavares came out publicly and said, well, he's always aspired to be the CEO of a big auto company. Of course, who was CEO at that time? His boss.
Carlos.
Ghosn. Yeah. And so that didn't go down well. Carlos apparently, reportedly told him to retract that statement, told him that he should not have said that because it makes him look, vulnerable, given he's the head honcho at the time. I'm going to whack up my picture with Carlos Ghosn as well at the Paris Car Show. Yeah, there you go. And the interesting thing, I miss the car show. I miss driving all those cars because I just love trying out the latest technology. Actually, the most cool bit is not the driving of the cars, it's testing the technology. And even then, it was all about data. Funnily enough,
what do we think this
really
move is going to be in Stellantis today?
I think it's going to be positive, given it's been beaten down so much.
Right.
That's just my view.
You think Elkman will find Elkan will find a good replacement? Because that's the big problem, isn't it? That the biggest shareholder in Stellantis has said no more. This is enough.
Yeah.
But it has happened very quickly, so I doubt there's somebody in mind.
And he's done it 1 year in advance, or he's 1 year ahead of when he was meant to go.
Yeah.
So I think I can't be able to hold things together, even if he doesn't find someone straight away. And he is well respected by the board. I do think that they need to find someone soon because this is a painful sector to be in right now, especially all the changes that we've seen recently, right? And so I think for the short term, I think its shares might have a bounce just from a relief rally, relief bounce is my thing. What do our viewers think?
Tricky one. I mean, France is already down 1.5% on the mess that is coming into the no confidence vote this week in France, by the looks of it. So there you go. There's the futures down 1.4% already in France, with nothing else going on. A whole load of nothingness. The Nasdaq unch. FTSE is up 0.02%. So really, we are going to be focusing on the CAC today. And of course, that story is that the far right, Marine Le Pen, is trying to dictate what goes on in the budget and is being told, no, we are not listening to you. So it looks like we'll move to a no confidence vote at some point this week in France. Just yet more of a mess in Europe, completely getting left behind relative to the US. And now you've got France and Germany with a confidence vote and a no confidence vote.
You're not going to have a sort of contrarian view on the cat, come on?
Yeah, I mean, you just can't. When the incredible zoo that is going on in European politics at the moment, not just in our chat, then yeah, this is just it's uninvestable. It really is. It's such a joke.
Speaking of a zoo, China's Caixin manufacturing PMI, that was another interesting one, hitting the highest level in 5 months. This must come as a relief to those of you, including Tasty's Frank Caberna, that has a bullish China view. Yeah, he does.
What, from when he was here, or?
Yeah, when he was here.
I think it might have been updated now, 4 months later.
Yeah, I know, but he was kind of like, this is before China Tuesday, right?
Yeah.
And he was like, come on, China, come on, China. He was like,
he's on the show at 12:30 today on his FX show, so we'll have to pop a question in the the comment section.
Rib him, because before that, before China Tuesday, he had already been long China for about more than a year. So he was like, come on, come on. So I hope he took profit after China Tuesday rapidly, because we all knew what happened a few days after that. But this is a spark of bright light, a chink of light in a tunnel for China, because it is the second straight month that manufacturing has expanded there. Clearly, this is going to be good news, given they have tried not as big a bazooka as we had expected, but it has been trying to boost its economy there with stimulus. However, it has failed to have the required effect. Some say more stimulus is coming, others say that that's probably it for now. But the Caixin survey in the short term anyway, showing that the market sentiment across Chinese manufacturing improved for a second row in a month in November.
Right, we've got a supreme deal this morning. And I'm not talking Aviva Direct Line. I'm talking exactly why Monkey Man's offering everybody a cup of tea this morning, and that is Typhoon Tea has been rescued. So we got Supreme, the consumer goods wholesaler, has bought Typhoon Tea out of administration for 10.2 million. There you go. I remember Typhoon from my gran used to make me Typhoon.
That's why I needed rescuing.
It really did. That was
I'm more Yorkshire tea.
Oh no, big fan of Yorkshire as well. I think you're right there. Yeah. Although we've got PG tips in the kitchen here, don't we?
We do, but we also have this like really fancy stuff that doesn't taste very good. Can I say that? Got this fancy stuff in a silken triangular.
You can say what you like, Ange.
Right, triangular bag. No, I just don't want to look like, I don't laugh a gift horse in the mouth. And also, it's in this fancy silken tea bag thing, and it just is so
too posh,
so weak.
Yeah.
Tea has to be strong. Your teaspoon has to stand up in it. There you go.
Right now, just on the back of that China headline, let's look at how commodities are doing this morning. It's not been taken well by gold. Gold down 1%. Sorry, not gold. Gold down 70 basis points. Copper down 1%. So yeah, copper down 1% on the back of that. Aluminium down 40 basis points. Zinc down 80. But yeah, gold, silver, palladium, they're not reacting well over the weekend either. So precious metals off considerably, even after a decent sized gold deal being done in Australia. Mm-hmm. So there's more consolidation in the gold sector. That was a $3 billion deal between two gold miners in Australia. Now,
with gold, I'm waiting and watching, but with oil, if you're trading WTI or Brent, just bear in mind that markets are a bit quiet at the moment because they are waiting on OPEC Plus later this week. OPEC Plus meeting, of course, to decide on output yet again. And I'm sure that OPEC ministers will be looking at what's been happening, especially Syria recently, before making a firm decision.
There we go. There's a story from Yahoo Finance for you. And we've got Yeah, there we go. Oil rises with focus on China's economy, OPEC plus supply meeting coming. And then Anne just put some technicals for you onto the chart.
Yeah, that one was just to show you the hanging man, which we talked about last week, but also what I'm looking out for here. Monkey man, I know you like golden lines. Those of you that trade WTI, I'm looking for that move towards my golden line there, 6934. If it fails and turns south, then I'm looking at a breakthrough 6784 for further downside, and we'll trade it that way if it breaks through that support level. So those are the two levels that I'm looking out for before taking a position. I'm hoping that that will come today. What are you looking at, Rich?
Well, looking at Apple apparently, because Gavin has a short-term target on Apple of 245, so 245 bucks.
245. Isn't that a song?
What song is that?
I think there is a song with 245 in it. It will come to me. It will come to me. All right, Apple.
Right, Brian Adams or right, Apple. Yeah. So and also waiting for Amazon to give a bit more of a bite there. But yes, Apple, I must admit, I'm in the mood for selling some downside puts in FTSE names like your SSEs and there was another one I thought of over the weekend that I thought, well, probably more Vodafone. And then selling upside calls in some of the S&P names because, I mean, we're just getting to the point now. I can't see how there's upside in some individual names. And the ones that are on high vol, high IV ranks, then it just seems to make sense to me to sell them. But also names in Europe. I mean, you know, Stellantis, would you dare sell puts on that? I don't know.
I'd love to know your thoughts on AstraZeneca and BP, because I have those positions and I'm just wondering what I should do with them in my pension portfolio.
Yeah.
They're more for like
it's your big part of the FTSE, isn't it? So it's right. Do you want individual stock risk in those, or should you just be in the FTSE 100 tracker?
Yeah.
I wouldn't. You know, Astra's had an incredible couple of years. It's obviously had a tricky 2 months with the China issues, and then BP.
Oh, yeah.
I mean, it looks awful, hasn't it, on the chart?
Yeah, even more awful after the last CEO. But you know, they were initially put in there for like a safe divvy type stock away from the tech. I was trying to get away from tech, namely Nvidia.
Yeah. No, but you're just hedging because you're very long tech, aren't you? Yeah. So.
But that's what my returns for this.
You're looking for diversification.
Yes, but I'm looking for good diversification.
Yeah.
At the moment, I'm not really happy with my 15% return expectation.
Now, there you go. That is for me. That is the flag in the top of the market. Not happy with 15% up. I mean, what do you want? I like good returns. You're one of these crypto meme stock traders, aren't you? You want a 3-bagger for your pension.
and more. Speaking of 3-bagger, I'll
take my 15%, thank you.
I really like this story, and I don't know whether we covered it last week, but I thought of you when I saw it, and loads of other people who were kind of like feeling that FOMO about not getting those deals in. But did you see this last week? Amazon workers planning global protests. Right? And strikes.
Did it go through?
No, I don't think it went through. But I think in Germany maybe it did. But I don't think it went through in the
Germans
US.
out on strike, just like in Volkswagen today. I think that starts today, doesn't it? The Volkswagen strike.
Yeah, the Germans. But it looks like it didn't happen in the US. At least I didn't hear about it. So if you heard about it, let me know. A few days ago, they were talking about strikes, not just in Germany and the US, but also Brazil, Japan, the UK. I certainly didn't hear of any going on here, unless it was quashed last minute.
Now, good morning, Andrew McKelvey. On the gold front, OMI watching OMI after a drill result. That's interesting. Have a look at that one. And then, yeah, NVIDIA, that is actually one. That's one that I'd be looking to sell downside on. So actually probably do a strangle on that. I think 170 is probably the top, maybe 120. Sell the puts at 120. So 120, 170 strangle on NVIDIA. That would be something I'd be looking to get involved in as well. Now, quick 3-minute break and we shall be back ringing the bell on December.
Rise and shine with IG's new morning show, Trade Live with IG, covering all our UK product offerings, including our OTC and exciting new US listed products. Starting in September, join us every weekday from 7:30 to 10 a.m. for exclusive insights from our trade desk, expert trading concepts curated by our friends at tastylive, global guest appearances, and loads of viewer interaction. Regular platform feature highlights and up-to-the-minute market updates. From casual chit-chat to in-depth analysis, we've got your morning covered, live on IG.com, YouTube, and in IG's trading platform. Whether you're a seasoned professional or just starting out, there's something for everyone. Tune in, stay informed, and kickstart your trading day live with IG.
Fundamental analysis is a method of evaluating assets to assess what their prices should be. It's based on the principle that every asset has a real fair value, which may be very different to its current price. It assumes that markets will naturally correct to reflect these fair values over time. The aim is to discover assets that are currently underpriced or overpriced, then place trades to profit from the expected correction if it materializes. Now, unlike a technical analysis that focuses on price charts, a detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry trends, and a company's management team may form part of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Right, we're back for opening the bell, but we're going to go straight to my fantasy team because that's far more important than anything opening there. So 76 points, very happy with that. Average points of 60 this week. You see, Virgil gave me 6 points at the back. Pickford gave me an absolute rubbish donut there. Gabriel scoring, and I think he got an assist as well. Palmer, of course, the treat of the day. Captain Salah doing exactly what he's meant to do. And even Nielsen. So yeah, I was very lucky because none of the bench players played. That was my 76 points. Thank you very much. Monkey Man, tell us who was in your team. I think you popped that in the chat earlier. There you go. Saka, Palmer, Salah, Visa. Wow. Yeah, who was your captain out of that lot? Right, 1 minute to go, Angeline. What are we looking at on the open today?
I'm looking at UK house builders, looking at my watch list there because UK house prices rose by the most since March 2022. This is according to Nationwide.
Much more than expected, wasn't it?
Yeah, it was. And also, you know, don't forget house builders like Barrett, Taylor Wimpey, Bellway, Kingfish and Travis are there because they related to this sector. I just want to see what they are doing. That's why they're on that list. But Crest Nicholson, those UK house builders all been beaten down. And so I am poised.
And they're off for December. Train line straight up 2.5%. Travis Perkins down 2.5% as well. Let's see where Stellantis is going to open, Ange. Have you got a Stellantis price yet?
I don't think so. It might just be...
Weatherspoon's down 5. What's going on there?
Yeah, no Stellantis down 5.4%.
Down 5.4, yeah. Right.
Look at that move. Unbelievable. Look, this is the 1 minute chart to give you a look at what's happening there. But be careful for the bounce back if you're trading this, because it looks like it might already be in place. So for those of you just joining the show right now, Stellantis coming after Tavares stepped down about a year in advance. Elkan now looking for the new
got chopped,
helm.
Basically, didn't he?
He jumped before he was pushed, basically. Yeah, so that is what's behind the story, and we're seeing this on the minute chart starting to move back higher now after that sharp fall. If I show you,
right, what? Sorry, go
on. Just how far this has fallen.
Look at that.
Since 29th of February 2024, it has.
Guys, you want to get that chart up, please?
Fallen from that 2724 level all the way to 1190. So very, very.
So what was the peak? 22.
It was
2,600.
Yeah, 2749 is what I'm getting here. At the top of the February 2024.
What's that's the.
This is the monthly.
I've got it 1180.
Oh.
Because you're on the spread betting. Sorry, I get you now, right?
Yes.
So yeah, €11 86, down 5.2%. Stellantis trading. Okay, what have we got else happening? So WH Smith, strong start to the morning. Halford's strong start. Burberry up 1.7. Imperial Brands trading all right. Then we've got Weatherspoons. Can we shall we chat to the trading desk and find out what is going on in Weatherspoons? No, there we go. It was a funny spread going on, so that's more like it. Down 0.7. Travis Perkins down 2.4. Ocado, where I'm getting my Christmas dinner from, down 1.6. Persimmon down 2.8. So yeah, that is
just checking on the luxury makers as well. They're very mixed. They don't seem to be paying much attention to that upbeat Chinese manufacturing data. Having a look at the crosses as well for you. Cable down 0.5% as we speak. The US dollar, let's have a look at the US dollar basket there. It is up 0.5% there, perhaps getting some support as Donald Trump demanded that BRICS nations commit to not creating a new currency to challenge the US dollar.
Do you know, there's a great article today on the fact, let me see if I can find it. The Chinese bonds reached new highs today, and as I think it was the 10-year dropped under 2%. So some real issues there for Chinese yields. But just seeing if I can find it for you. I'm pretty sure it was. Yeah, there we go. So China's renminbi falls to 4-month low after the Trump tariff threat. So we had currency weakening to 727. I have actually gone short, small short, just as a tester. Yields on the 10-year Chinese government bond fell below 2% for the first time. Everybody's making the comparison with Japan, of course. So I'll just quickly show you what I've done. I've done it in very small size, but buying US dollar CNH at 727.70. And so, you know, obviously wanting that to go up because I'm long, but that is me short the renminbi. But that is, very small size, just trying to have a little tester. But I do think there's a chance that that has to continue because I don't think necessarily US rates come down as quickly as we think. Let's have a quick look at the Fed watch there. We got 67% chance of a 25 basis point cut at the December meeting. But so that would take us to 425 to 450. If we look 3 months forward to March, then there's still a 40% chance we wouldn't see any other cut after that. Whereas Chinese yields being below 2% for the first time, that, and they have to be down there because China is really fighting deflation at the moment. I think that currency potentially has to weaken. Then, of course, you're helped by the Trump. That's my hedge against these Trump tariff threats as well.
I'm currently going to put on a position on oil at the moment, just a small one, just because I just want to test this out at the moment. And the minute chart looks like it's going my way at the moment. So I'm going to place the deal there. I'm going to see whether it crosses 6830 before putting another leg on. Checking on some other of the commodities in this space. Gold's down almost 8% there. Watching that with interest, given we saw over the last couple of hours this ongoing conflict that's erupted between Syria and Russia. Of course, Iran as well, fighting other conflicts there. Palladium down 1.8%, platinum down almost 8% as well. High-grade copper, interestingly, a bit meh there, even after that Chinese manufacturing number. So they don't seem to be taking much notice, down 1.2% there.
All right, now showing you the chart of Stellantis. It's dropping further now, down 7.4%. The falling knife is in motion. Dare you catch it? I am not going to touch that with a barge pole today. 1160. That is just, I mean, where do we go back to see it? Has it been this low? Yeah, there we go. So, how far back is that? Is that before the, yeah, right back to the lows. There we go. Right back to the lows in Stellantis, which were in October. Now, what happened there? Was that a profit warning? October 11th. We got a bounce from there. Got it so far ago. That's what, 10? No.
Was that October 11th this year? Or last year?
7 weeks. No, this year.
Okay.
Yeah.
Stellantis.
So there we go. Back to the lows. It's tested it. It got as low as 1158. So that was.
Oh, that was the day. That was the day when they said Tavares would retire in 2026.
Ah, okay.
And then they announced the management shakeup, right? So that was probably the day when it reacted to. They gave a date that he was leaving.
Right. Well, it's bounced off it first time. So let's see if it can hold that 1160 level. That is an important one because I can't imagine where we. I don't know if we've got anything to compare to before that, do we? What's
Nope.
Kanj? Have you had a look to see where it was before?
I wouldn't touch this either. I just think that it's got more pain to come. Until this is one stock that I would trade the bounce, not the actual reaction. It's a bit.
You wait for it to show some kind of.
Exactly. I wait for it to bounce off the bottom and then catch it on the way up, because then I can put in my golden lines to see where I exit and get off that train. This is to me a longer form of Aston Martin at the moment. you know, I can't see.
I've got a car crash.
Yeah, in slow motion in the technical world. So I wouldn't touch this until I see a proper bounce.
Right, let's have a look at other moves. So for Expo, up 7%. For Expo, up 7%. That is an interesting one. So obviously got the mines in Ukraine that it's hoping to start up as soon as any deal would be announced there, hopefully. Then after that, we're struggling to see too many. It looks like a bit of defensive positives in the FTSE. On the negative side, Persimmon down 3.5, Vistry down 3, and yeah, so negativity in the home builders there.
Plenty of other things to look out for today as well. Trump is, I think, meeting with Trudeau after pledging those steep tariffs. Like, hey, man, good to see you. I thought, yeah, what do you think about what I did last week?
Trump speaks?
I can tell that's how Trudeau speaks because I've met him as well. You've got better skin than Trudeau.
Good
Seriously,
to hear.
yeah. He is a tall man, really good looking, and I don't know who he has on his team, but they do a brilliant job because whenever he's taking those pictures,
Covering all the important topics right here.
yeah,
Trade Live with IG.
And he's also he's got that gift of the gab, and he does sound very friendly. So I'm sure Trump will get a nice welcome from him before he kind of goes, right? So they are meeting later on. Gold also, watch that one because it's I believe currently slipping. I checked on it just now. Is it still slipping? For those of you that trade this elsewhere, it's XAU equals. On the IG universe, it's just gold. Actually, it's come back up again. Gold not able to decide what it's doing. Let's see the 1 minute chart. Yeah, it's coming back up again. So keep an eye on that, people. It looks like gold is doing a bit of a reversal on the 1 minute chart and also on the 10-minute chart that it was slipping earlier on, but now it looks like it is moving back up again. So maybe a reversal there.
Now, yes, so the FTSE cash chart on IG. So AP asking, is that AP as in the watches, do we think?
Yeah.
Fan of that. And can only see the normal 24-hour chart. So let me see if I can, so I've got the FTSE futures. Oh no, here's, yeah, FTSE cash chart. So here we go. That is my FTSE cash chart, and then I just go up here to click between the time frames. So yeah, if you want to go shorter term, is it? Can only see the normal 24-hour chart. Yeah, if we can, there for example is the 5-minute chart, and yeah, it doesn't really look like there's much going on there, does there, Ange? It's still stuck. That's what I want to do today. I knew there was something. Let's go to the options market and sell some more downside in the FTSE. So January 17th expiry. Where do we have to do to get some premium there? The 8,000 level, it bounced off the 8,000 quite well. We get 31 ticks for that. Or, well, yeah, that's good enough for me. So I'm going to sell £10 a point of FTSE 8,000 puts there, and that's confirmed.
Whilst you're doing that, Volkswagen, a big mover there. As you can see, I've got the 10-minute chart up there. Just put a position on 9. Volkswagen plants to strike.
I was hearing plenty of that over the weekend.
Oh, well, to strike. 9 Volkswagen plants to strike as the Labour battle intensifies. For those of you watching the story, IG Metall saying that the assembly lines will come to a stop as long as the Volkswagen's German operations don't come to an agreement over the latest labor dispute. At the same time, Volkswagen India, I don't know whether you saw the story, also looking at a $1.4 billion tax evasion notice. So just looking at Volkswagen's share price, it is heading lower. I have got a stop at 82.50. Russia's VTB, this is something else that I was watching over the weekend, to buy the Zvezda shipbuilding yard from Rosneft. Staying in Germany, back in Germany though, Rosneft. The UniCredit CEO, were you the one that said you had a position in UniCredit, or have I got, is that someone else?
That is somebody else indeed.
It might be Chris, but there's been this talk about UniCredit's CEO looking at a takeover target in Italy. But that is still brewing there, still in play. Biggest story today, I guess, is Stellantis falling some 7%.
Well, it is, but Andrew McKelvey has got another one for us here, which is Orosur Mining. Now, I've just been looking at it. You might have seen my my smile on my face as I saw this go from last Tuesday. It was trading at 3pence, and now it's at 6. And so that is due to a update on Colombia. So there we go. The ANZA project is now 100% owned by the company. And this, now Andrew said it was a drilling update. Yeah, there we go. From first drill, the PEP returns exceptional result, 66.75 meters from the surface with, that is golden, some would say. And they've just completed the second hole of the program with rig about to commence on the third hole. Now, remember, this is a small cap indeed, people, so come with big warning signals, but I thought it was worth highlighting as Andrew, of course, has given us the heads up on Ferexpo before. That was a great one. So I haven't traded in a penny stock in years. I don't think I've ever made money from a penny stock, I must admit.
I know people who just trade penny stocks all day long, and that's all they trade. But I agree with you. I don't really. You
can't trade them because of the spread, right? I mean, that's a 6% spread, so you can't really trade them.
I just like liquidity, so I don't normally like trading them. So, and speaking of liquidity, Delivery Hero, have you seen that recently?
No.
So I've just put that one on whilst I was talking to you, because this one is showing me a good. So it's down 6.5%. But what I'm seeing here at the moment, this is the 10-minute chart. I'll show you the minute chart.
Just remind us who Delivery Hero are compared to Deliveroo and.
So Delivery Hero is the delivery service, but mostly in Europe. They're big mostly in Europe, and I think they started
a European Deliveroo.
Yeah, and they started off strong, in a strong position in Germany, and then they started, moving out to the rest of Europe, and they were one of the darlings during lockdown. And it has super fast riders. It's also got a unit in Spain that's not called Delivery Hero. I think they're called Glovo.
Right.
And what's happening right now is, like all the delivery outfits, they're having to retrench, they're having to change, some of them not rapidly enough to try and diversify away from the business model that worked really well during lockdown. And Delivery Hero here saying that global riders in Spain to become employees, because many of them, as I'm sure you know, are also now trying to navigate the regulations, because in many places like the US and the UK, they have to now grant these zero contract people contracts because they've worked over a number of hours, and so therefore they should get things like sick pay, etc. Not great for the company, but good for the employees. We've seen this with Uber as well,
that's
right?
what I'm on here.
Yeah.
I'm on a 0 hours contract.
Is that why you're here all hours God gave?
Yeah, the more hours I'm here, the more I get paid.
Rich, where are you? He's under the desk. He's still at work.
But I also, that's why I left it at 10 o'clock on the dot the other day when you were still going on to 10:02.
Is that when you sent me the picture of the trainers and I was like, is this a good deal? It's not a good deal. Your trainers look very expensive. They're more expensive than my knife was as expensive. It was a tiny knife. So anyway, they've been fined before. Glovo had been fined before, some 80 million euros for failing to contribute to Social Security and being a responsible employer.
Right, and how's Delivery Hero on the longer chart?
So Delivery Hero on the longer term chart, I don't really trade this longer term, but I'll show you anyway. It has, as you can see there, recovered slightly, but nowhere near to its heyday during, the lockdown period. If I go back even further, can you see how far it has come since then, right? At 14235. This is a daily chart, people. And so it did so well during that time, but like many of the others, once everyone came out and was able to resume normal life again, their share price languished.
Okay. The Deliveroo is looking interesting as well. So that's most probably got something interesting there on your chart world, Ange, because look at the support line upwards trajectory that it's got there. That to me, that looks like a channel.
Yeah.
Which is interesting. Not a huge fan of Deliveroo, even though they're in the same building as us here.
Downstairs.
But I must say it's better than my delivery service because somebody's stealing.
No.
So it's called non-atonda, and we get it once a week delivered on a Tuesday. And the last 2 weeks running, the delivery driver's taken a picture of it, and then it's suddenly not there 2 hours later. So I reckon the delivery driver's probably had quite a nice pasta meal, freshly cooked.
Or is your neighbour starting to look quite plump?
No, the neighbours, so, they don't take any Amazon, so I don't know why they would take a pasta dish.
Is it any good, non-atonda? I've never had it.
It is when it's actually there. But I had to go and make something on Tuesday night.
We've had neighbours on our street that have put dog poo into Amazon parcels.
What?
Just because there's someone, and this person's been recorded, but they're almost like all hooded up to the point where, do you remember South Park? Do you remember that character that pulled the hoodie so tight you couldn't see the face? Kenny?
Yeah, Kenny, yeah.
So it's like a Kenny character, and weirdly wearing like very, very bright orange fluorescent, right?
Yeah.
But you can't see the face because it's like Kenny. And this person just comes and it's all recorded. Everyone's got those recorded doorbells.
Right.
But just walks off with the Amazon parcel.
Wow.
And so I had some neighbours so frustrated they've put dog poo in, like.
And did that one get taken, or did it just stink out the?
Oh, it got taken.
Well, that hopefully stopped that. Right. On that note, let's go into confirm and send.
Welcome back to Confirm and Send, where we answer all your questions. I do have a confession, though.
Oh dear.
I have not managed to see this week's Confirm and Send just because it was just such a mental weekend, but I will try my best.
No pre-planning. Right, well, this is a good test then. Let's go to question 1. In Forex, what are the advantages of an interest rate differential strategy?
Thank God! Thank God! A question that I know how to answer.
Go on, Ange. Let's hear it then.
Interest rate differential strategy. It's really advantageous because, I guess one of the easiest examples that we've talked about a lot on the show, Rich and myself, is, of course, the carry trade, right? So the basic idea is you borrow a currency from a country that has either a decreasing interest rate stance, if you like, or near zero, and then that is then used against a stronger currency or to buy a stronger currency. That's the basic premise.
You got Neil suggesting the euro against the Swissy.
There you go. Or, for example, at the moment, a stronger currency with a increasing strength trajectory is the dollar, right? And you could pair that with the euro. So it's super important to understand this because it's very advantageous. It's also very advantageous if, for example, you trade the FTSE, because most of the companies that are listed on the FTSE, at least 50 to 60%, have their revenue in other currencies. And so understanding that enables you to understand whether the revenues will be translated into a better balance sheet in the UK for the FTSE.
Of course, and remember, we're talking about real interest rates because you have to take into consideration the inflation rate as well. So, of course, Japan, as we know, for over 20 years, has had a really, really tough time getting any kind of inflation through their economy. And subsequently, interest rates have been very low as well. But that all changed last year. So you can see, well, 18 months ago now, geez, time flies. We can see what kind of effect that had on the Japanese yen. If we go to that weekly chart from December 2021, of course, when we started getting interest rates in the US, interest rate expectations started to go up very quickly. You saw the yen go from 105 pretty much in a straight line up to 150, right? And that was purely down to those interest rate differentials in that you weren't getting any inflation through Japan, but of course, throughout the rest of the world, we were seeing huge amounts of inflation. Therefore, the currency was depreciating. The interest rates in the US went up as far as 5%. And you see a bit of intervention there in October 2022. And we retraced from 150 down to 130. But yet again, the Bank of Japan was really struggling to contain this differential from 5% rates in the US to 0.5% rates in Japan. And that all until July of this year, we started to see the interest rates go higher in Japan and also talk of further rate increases. And that sent us spiraling Japanese yen strength from 160 down to 140. So big moves to be seen from interest rate differentials. You've got to know what's going on with regards to the central banks. You've got to know what's going on with regards to inflation in that country.
Also, this is why you hear Rich and I talk about, listening into the central bank press conferences, because it tends to be there when the action happens, normally buried in, it's never like the first 5 to 10 minutes, it's normally after that. But if you look at my chart now, whack up my chart, if you were, for example, trading the Aussie versus the yen, around 2002 to 2007, you would have really been having this big smile on your face if you had a long position on this pair during that time, because the interest rate differential between the two was huge. From 2002 to 2007, the Reserve Bank of Australia raised rates to 6.25%, whilst the Bank of Japan kept their rates at 0. So understanding what central banks are doing when you are trading currency pairs is essential.
Right, just quickly, we have seen Stellantis smash through that 1160 level. So it's gone. The support from October has gone in Stellantis. We're now trading 1150 to 52. Let's have a look at the quick 3-minute chart on that. And as you see, down, down, and down we go. There is no support. Yeah, so painful as the CEO departs with a swift boot from the chairman.
The gear's broken, the brake's broken, and it's downhill.
Question number 2, please. Right, what do I need to consider if I want to buy a mining stock? So this, I had the great joy of being moved to the mining desk in January 2006, just as the Chinese super cycle was taking full effect. So yeah, great few years there. And these were all the things I used to have on my watch list. So the first thing you need to know is the stocks here, such as Anglos, Antos, Glencore, Rios, BHP, and yeah, a bit lower down as well. We can go down to Norsk Hydro, Freeport McMoran, Metals in steel. But you need to know what their portfolio of commodities is made up from, right? Now, Antofagasta is purely copper. So that is obviously going to move very much relative with the copper price, but it also has some gold. So they're called buy credits. So when you mine copper in Chile, then at the same time you're pulling some gold out of the ground. Now it doesn't really, talk about it. It's not a gold miner, but it just gets these things when it's trading when it's pulling the copper out of the ground. So it sells them immediately and takes that off the cost per pound of producing copper. So the 3 things that go into your Antofagasta price are the copper price, the gold price, and the currency, because of course the Chilean peso has been relatively volatile. That, compared with the likes of Rio Tinto, which is 80% iron ore exposure, would be a completely different the catalyst for why you would be trading Rios. So that would be a pair trade that I would put on, for example, if I was bullish on iron ore. For example, in we had 2018, there was a big problem in Brazil, and you had a real tightening of supply of iron ore throughout the world. Iron ore price went up 50%, and of course Rios were not affected by the supply problems because it didn't have any mines in Brazil, but it benefited from the price that was going into China. So, knowing exactly what commodities move which stock, where they are in the world, then that's what you need to know. As we saw for Expo moving at the moment on any headlines around Ukraine. Anglo-American, big South African business historically, it's trying to divest. So the South African rand would move Anglos. So yeah, it's an incredible sector. It is a lot of fun to trade. You need to have your eye on geopolitics, on currencies, and on weather. Amongst other things. So yeah, so that is the mining world, closely tied with the world of steel, of course, because steel is what demands a lot of the coal and a lot of the iron ore to go into the steel making process. So also trades off the back of commodity prices and Chinese demand.
And Rich is right, you have to really have your wits about you, especially when you're dealing with miners, because it's not just, that is included in the price. It's also things beyond the miner's control. And what I mean by that is abductions. We just showing you working at Resolute Mining there because you saw in the back end of October, November, this big reaction there, big fall, and this is because there were more abductions, and this has now come to a situation where the gold miner has had to pay Mali £126 million after its British boss was detained by authorities. This is a dispute with the West African country, and it wasn't just him, it was also not just a boss, it was also 3 other employees. All 3 were detained, and they were British nationals, and it was a big dispute about taxes, levies Also, the other thing to consider is that many of these big companies, I'm sure Rich in some way or another was impacted by this, and pardon me if I mess up the pronunciation, but I think it's Fundão, the Fundão Dam tragedy, where Brazil ordered mining giants. So if you were trading BHP or Vale, as they call it, during that time, their Samarco iron ore joint venture resulted in this big disaster when the dam burst in 2015. Many people died. The Rio Doce River was also severely polluted. And so even until this year, they are still talking about the ramifications of that disaster. It's $9.7 billion so far that they've been told to pay because of the disaster. And I don't know what Rich's view is, but because of all this in the sector, I do subscribe to quite a few mining journals, mining email, digital newsletters as well, to keep abreast of all this news. But also, I prefer the actual commodity itself, because it's very tricky, unless you're very specialized, to pick out the winning miners. Monkey Man's got a question about dividends on the chat.
Now, at what age should we be looking to move more to dividends for income due to retirement? And that's very exactly what you're talking about, moving out of your tech, which is obviously zero dividends, and you'd be going for capital appreciation. Are you going to now start looking for dividends instead?
Well, I have, Monkey Man, and I have to tell you, can you see my face? I have to remind myself each time that I have to diversify, although it is a bit painful, because when I'm looking at the difference with my tech portfolio, it's returning 25% on average. And then my diversified portfolio with no tech in it, Rich has got to look at his face like, it's 15%. I messaged Rich 2 weeks ago going like, should I be worried about this? Should I be worried about this? But at some point, I have to bite the bullet and I have to start diversifying. And so that's what I've done. These companies that are non-tech in my diversified pension portfolio pay strong dividend yields, and also it depends on your lifestyle, right? Not everyone's lifestyle is the same. I have 2 young children. I have 5 pensions. I need to start diversifying because I can't have all 5 in tech. So I would say that once you are in that position where, you know, my view is I've now got a home, I am trying to be a bit more responsible. I've got, Rich is laughing, I've got dependents. I've also not got to the stage yet where, you know, my in-laws or my parents are very ill, but they're kind of getting ill, as many of you know. And so I'm trying to do that before the real crunch point, right, of having to really look after people. So hopefully it evens out. Your time frame, Monkey Man, might be different to mine. I mean, you might be pulling in the big bucks like Rich here, and so you're just stuffing it away, right? And you don't have to worry about those dividend stocks until much later.
I love how you just make things up.
You're the one going for like £600 meals.
The best thing that I have seen with regards to dividends is a ETF called the US Dividend Aristocrats. Now, these are really quality companies that usually have a history of raising their dividends. I think it's one of the things they have to have not done is ever cut dividends. So it's only a one-way track. And let's see how far back we can go on this thing. Yeah, there we go. Back to 2017. You can see that we've had about a 60% increase there since 2017, but you've been getting paid dividends the whole time as well. So if we can come off there, I'll just have a quick check of what's in it at the moment.
Yeah, that's my next question. What are the constituents?
Right, so the there's a global one as well. So maybe the global one would be more interesting at the moment because of how, let's say, enriched the US is. So let's have a look at the holdings at the moment. There we go. Not ones that I have heard too many of. Highwood Properties, KT&G, 1OK Solvay, Verizon. But yeah, so that is the version that is the global dividends. Let's see if we can get the US ones only. There we go. But yeah, that is an alternative.
I have the US one if you want to whack up my screen. So the US ones have names that I'm going to move it over. I'm more familiar with, Rich. They are Chevron Corporation, Realty.
Do you want to zoom in a bit?
Yeah, there's I know Kenvue. I don't know Excel Energy, I have to say. Kimberly Clark, yes. ExxonMobil, the company that, very early on already said that global warming is not a thing. Archer Daniels Midland Company, that one, yes. And of course, IBM.
Great. So that's the Aristocrats ETF. So they, historically have always raised dividend, never cut them. And it's about as solid a dividend play that I have been able to find. So now, talking about new ideas, we're introducing Pega to the options market in 5 minutes. We'll see you then.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Trading the news is an essential skill for all traders. Major news announcements can often cause large price movements, particularly in Forex markets. So, here are 5 key pointers to help you try and make the most of those moves. 1. Do your research. Know the times and dates of important events. Use an economic calendar, for example, the one on IG.com. It's a vital tool to help you plan ahead. There are many announcements on any given day, and it's essential you know which will affect the assets you're trading. For a Forex trader, generally any event impacting the US dollar is important. Events like non-farm payrolls, Federal Reserve minutes, and GDP. If trading shares, look out for company earnings, dividend payments, and stock splits. 2. Check what the market expectations are for the event. Look at a chart of what happened last time. How did the market react? Was the data better or worse than expected? Did earnings beat or miss estimates? Use what happened in the past to inform your future trades. 3. Study related news and events. What else could impact the market in the wake of the announcement? Take crude oil as an example. US inventories are due on Wednesday. If there's an oversupply, the price should drop. But say OPEC ministers are meeting Thursday. If they reduce output, the price could rise. So, it's essential to look at the overall picture and not take each event in isolation. 4. Put a strategy in place. Know what levels you want to buy or sell at and where to put your stop losses. This will help you to have the courage of your convictions and avoid knee-jerk reactions. And finally, 5. Learn when to fade the news. Here's an example. The CEO of Company X announces he's leaving. The stock falls, but you believe the company's fundamentals are still sound and the market is overreacting. So you hold your position. If you're right and the price rises, you could profit. Of course, if you're wrong and the price continues to drop, you'd make a loss. Remember, these are all just guidelines. While trading the news can be exciting, it is also risky. Unexpected results can lead to high volatility in the market. So, make sure you're well prepared, and always have a solid trading plan.
Welcome to Teaching Pega to Trade. So we're back. My favorite time of the week. Pega, you have just made me laugh so much. Tell everybody what just happened.
So as you guys might be able to see the beautiful graphics behind us, I am learning I am learning to trade, but I am not learning to be a great TV presenter because I forgot and wore a green top today. So in the commercial break, Ange very kindly helped me get dressed into some non-green clothing so that I'm not a floating head for you this morning.
Yeah. So for those of you that aren't in the industry and don't know how all this works, the background's not actually real. So it's a green, we've got a beautiful green wall in the studio and a green floor, and it's very picturesque, isn't it? But if somebody wears a green top, then literally they disappear. So Pega walked in and just disappeared, and we just saw a head in the camera, which has just been, yeah, brilliant. But that was a Ferrari pit stop.
Yes, it was.
Incredible work.
Maybe we can look into the automotive industry. Lots of talk about Jaguar's new ads.
Well, that's it. We've covered retailers. We haven't covered the autos. Thank goodness, the way that some of them are performing.
Yeah.
But today we're going into the exciting world of options.
Yes, I'm really looking forward to it. This is an exciting, we talk about options a lot here in the UK markets. And yes, I'm excited to learn how to trade them myself.
Have you been dragged into a teach-in or anything like that before? Or is this your kind of first look at calls and puts?
So the last time that I was taught about options was, I think, my senior year of high school.
Oh, wow, really?
So I have like a very basic understanding, and it was a few years ago. I won't tell the viewers quite how many.
Yeah, it's three or four if I was making a market. Right, we're going to look at calls and puts. Okay. Now that they make up the world of options. Now, have you ever traded an option before?
No, I haven't.
Have you ever bought car insurance before?
I have, yes.
Well, in that case, you pretty much have traded a put option.
Okay.
Right? Now, the reason that we call it a put option is because you are putting your risk onto somebody else.
Okay.
So walk me through your the discussion you went through to get that car insurance.
Well, basically, when I'm thinking about insurance, I think about like, what is the premium that I have to pay? Mm-hmm. So how much am I paying? And then what am I getting for that premium? So, you know, once I have the insurance, like, what is the excess should something happen?
And let's just say your car is worth 20,000, right?
Okay.
Do you want to tell everybody what you drive, or you think you?
I mean, I am like a typical rugby mom, so as you would expect, I drive a Volvo.
Oh, fantastic. Oh, well, I also had a Volvo in New Zealand, a 2001 version.
Yeah.
And this thing was incredible because we would go skiing. We live like, basically 12 minutes from the ski resort.
Amazing.
In Queenstown on the South Island. And yeah, this every time it got up the hill, and it was 21 years old at the time.
Yes, yeah. So it's we've had it for about 7 years, but it keeps going, and it's
and so
a workhorse.
let's just say it's worth 20,000 to keep the numbers even, right? What are your premiums for car insurance?
Like how much do I pay a month?
Well, for a year.
I have no idea.
Brilliant.
I think
the first world problems. So okay, let's say
I think my husband sorts that for the family as a whole.
And if you ever had a
I'm
claim?
responsible for the pet insurance, if that helps.
The pet insurance.
But same concept.
Yeah. Yeah, I don't want to. That would be too sad. For
Yes.
you to get.
Okay. So let's hypothetically say, if I had to guess, I would say it's about I think £500-600 a year.
Yeah. Okay. So let's say £500.
Okay.
Now, what goes into the company deciding what they're going to charge you?
Well, I think that they look at how risky we are as drivers.
Mm-hmm.
I think that they look at the value of the car. So if we had, a brand new, I don't know, like Lamborghini, the premium would be higher.
Mm-hmm.
I think that, how risky we are. Also, in my neighborhood, a lot of cars get stolen. So I think, where you park and I think what kind of neighborhood you live in. I guess South London.
You lived in Chelsea, Pega?
No, I live further south. I live in Clapham.
Right. Okay.
But it's a hot spot for
a hot spot. Well, especially the Range Rovers there. But yeah. And what about excess? Do you know what excess you have to pay? So excess being, of course, the car is worth 20,000, but you promise to cover the first.
I think it's around about £100 or £200.
Oh, right.
Something
So
like that.
Quite a small excess.
It is, yes. But I think it's also because, you can only go 20 miles an hour in my neighborhood. So nobody's going to get that hurt. Yes, exactly.
Right. So let's put this into terms of a put option. So your car is a Volvo. Let's say you've swapped that for, let's just say there was a Volvo stock.
Okay.
Right. So instead of having £20,000 of a Volvo car, you got £20,000 of a Volvo stock.
Okay.
Right. Now, at some point, you will decide, right, I am prepared to lose the first £200 of losses. Right. So that's your excess.
Yes.
So you come from where the stock is currently trading down to a strike, and you choose a strike where you want to be covered from.
And that's the strike price.
That's the strike price, exactly.
Okay.
So if the value of that stock drops through that price on a specific date in the future, right? So car insurance you're covered for a year, and then it expires.
Yeah.
So you can choose 1 month in the option, you can choose 3 months, you can choose 6 months, you could even choose 12 months.
Can I choose longer than 12 months or no? Is that generally the longest?
You can, but it wouldn't really make sense because you're paying a lot of something called time value.
Okay.
Okay. So instead of, I think what your question is, if you want to just be covered and forget about it, then what you do is you roll it and you keep on rolling the protection.
I see.
But essentially what you're doing is you're paying a premium to cover the value of your asset. Because the value of your asset is 20,000. You might choose, the first 1,000, you don't mind. Because that's just, a stock can go down 5%. That's just the way it is. But then you're prepared to pay 2% to make sure that anything below that, you can give the risk to somebody else.
Okay.
At any point for the next, 3 months. So that's all a put option is.
And am I right that I'm giving the risk to somebody else, but actually if I exercise it, I'm selling those shares, so I don't have them anymore, right?
That's exactly right. So you are you have purchased an option to sell those shares to somebody else at a specific date at a specific price on a specific date.
Okay.
So for example, if you had we've talked about Kingfisher, right?
Yes.
So Kingfisher, to protect yourself, you might have bought March 2025, £2.50 put.
£2.50. Okay.
So the stock's trading like 257, I think.
Okay.
Let's get an update on where Kingfisher is so we talk exactly. Yeah, Kingfisher, it's trading at 250.
Okay.
Right, but when we looked last week, it was trading at 257. So you would say, okay, I'm nervous. I want to buy a put option in Kingfisher at the price of 250, the strike of 250. So anything below that, it's somebody else's problem. Now, if it goes through 250 before the expiry, then the option would probably be worth more. Okay, so let's say you bought it for 3p.
Okay.
Right?
3p per share. Is that
exactly right?
Okay.
So that's just over 1%.
Okay.
If the stock drops 20% or 10%, then the option gets worth more and more.
So I can, I guess, do two things. I can either sell the option to someone else.
That's right.
Right? Somebody who needs it more than I do, maybe somebody who bought at £3 or 3.50, and so that option is going to be worth more to them than it is to me. Or I can just wait until my exercise date and sell it and sort of then balance out my portfolio that way.
There's a whole range of options. What you could do is you could roll the strike down to 230, and you would take a lot of profit out of the 250, but maybe you want to keep your stock, so you might roll the month. You've got a March option at the moment. You might roll that to June.
So you're telling me options have options?
Exactly, and that is it. It opens a whole new world of optionality.
Okay.
Right, and it's so exciting because there's so many things you can do in this world. It really, we've looked, at the sort of the basics, the primary school of trading up until now. This is secondary school.
I see. And that makes sense, actually, because we had the limits and the stops. And so, but it sounds like this gives you a lot more optionality, as you say. And so you can be more sophisticated in what you do rather than just trigger a closing position.
A sophisticated hedge policy now, with the car insurance, we said, right, you're a bit of a crazy driver.
Did we say that?
Well, we just, attention to detail, Pega, green tops, green walls. But
all those green trees.
All the kids making noise in the back, not watching the road. No, I'm sure you're a very, very safe driver. But if you're not, and I may have had a couple of accidents in my time, then the insurance company deem you as a risk. Or if you're 18 years old and you've just passed your test, you're a higher risk. So you're higher volatility. Now, if a stock like Tesla or Nvidia or those crazy stocks that move up and down and up and down, they're regarded as higher volatility.
So the insurance price, like the 3p in the previous auction, the premium would be higher.
Exactly.
Okay.
So everything that goes into it, it's the price, the strike price, the amount of time to expiry, so that's the time value of an option, and the volatility.
Okay.
Right? So it can have intrinsic value and it can have extrinsic value. But we'll come on to that another time. Now, that's protecting to the downside. A little bit harder to explain is what a call option is, right? Now, it's easy to say, yeah, okay, it's just the reverse of that. But I want to put it into a common day analogy for you to think about as well.
Okay.
So you mentioned you lived in Clapham.
Yes.
Right. Now, that reminds me when Battersea Power Station was being developed.
Yeah.
Right. It was going to take years. I think it was 10 years in the end it took. And of course, the developers need investment to work with just for cash flow. So what they did is they came to my friend Maz. Good morning to you, Maz, down in Riyadh. And Maz at the time was working in the city. He was a hedge fund trader. And Maz said to me, Rich, are you interested in Battersea Power Station at all? Now, if I know now what Battersea Power Station was like, I would have jumped at the chance to put a deposit down on an apartment.
Oh, yeah.
Right? So, and this was, it must have been 2016, 17, something like that. We had this discussion. You could put a deposit down of, I think, about £20,000, and that gave you the right, but not the obligation, to buy an apartment in Battersea Power Station when it was finished for £500,000.
Wow.
Right?
Do you know how much they go for now?
I mean, it must 900, 800.
I think considerably more. Yeah.
Do you think even more?
I guess it depends which one.
Right.
Yeah.
Well, it wasn't one of the penthouses. I will admit that. But for that 20,000, right, you had the optionality on Battersea Power Station being a success, which is stunning. You had the optionality in UK property prices. If they jumped, you could have locked in that price. And that's pretty much what a call option is.
Yes. Okay.
Right. So it's the option, but not the obligation to buy a stock. Let's take another example. What one would you like to think of?
The 20,000 in this example, goes, right? That's the price that's like the price you pay.
You could actually sell it on to somebody else.
Oh, okay.
Yeah. So that option in itself would have value as well. So it's not a deposit as such that it just goes. Yeah.
Cool.
Choose a stock that you think might have upside, but you don't necessarily want to buy it right now.
Am I allowed to? I'm not allowed to pick IG, am I? Should I pick somebody else?
I like touting the corporate line. I like that. Yeah.
I do think. Let's. Should I pick a US stock or a UK stock?
Anything you like.
Anything I like. Okay, then I would pick Microsoft.
Okay. Yeah, Microsoft is absolutely perfect example. Now, of course, do you want to run everybody through what tastytrade is and how we came to own such a wonderful company? How I set it up.
Sure. So I'm not sure what the viewers know already, but tastytrade is a business that we bought based out in Chicago, and it is a U.S. listed options trading business, and also it has a really cool content arm called tastylive, where they've done just an amazing job to bring the concept of options to the forefront of people's minds in the US and really shown them how options can help enhance their investment portfolios.
I think you've just done that better than Sosnoff would have done it. That's a great description. And now you can see the platform as well, which I've pulled up here. So very simple to use. I know it's a lot to look at, right? This is the great thing that they've done. They've managed to get everything you need onto one screen, right? If we wanted to look at a chart of Microsoft, we can look at a chart of Microsoft. If we wanted to look at news and research, we've got news and research, but this left-hand toolbar, very handy. There's all my activity that I've had in the past few days. And there's all my positions under one handy menu. So you can see, instead of trading options separately, you can see in Uber, I've got 3 option positions and it just tidies it away neatly like this. Same in Nike.
And are those because they're different expiry dates, or is it different strike prices that you've gone for?
Exactly. So the P is, let's see if I can zoom in a bit there. So that's a 62.50 put.
Okay.
And a 77.50 call.
Okay.
Okay, and that's how many days it is until it expires. And then that's the number of contracts that I've got. But what I would like to take you to is a trade in Microsoft. So let's go to really easy to find it, as you can see.
Yeah.
Now, Tom and the team think that 45 days to expiry is the optimal time to put a position on.
Okay.
For all the time decay and everything like this. So if we open that one, then you can see all these prices. Now, Microsoft is currently at 423.
Okay.
So where might you want to buy in the future? You know, if it starts to go up, then maybe you want to jump on that train.
So it's at 423 now. And I think, you know, with the Christmas season coming, I think that I can see the share price going up with people buying just like a wide range of products from Microsoft. And so I think that for me, what's realistic in a 45-day time period is maybe 450.
450, perfect. And then where might you want to sell it?
Ooh.
If it went up to 450, 470, would you be happy with 4%?
Oh, yes. So I would, so I'd buy it 450 and then sell it 470.
Exactly. So there, if we bought it 450, right, I've clicked on that one. So that shows you buying a call option. That is, I remember, look back to our Battersea Power Station example. You are paying a deposit of $3.30.
Okay.
For the right, but not the obligation, to buy the stock at $450.
Okay.
Okay. So you're paying $20,000 for the right, but not the obligation to buy an apartment in Battersea Power Station for $500,000.
Okay.
Exactly the same, right? Now, what you can do as well, because $3 is still quite expensive, right? You might want to say, but if it goes higher than 470,
yeah,
that's all I need for it. So you can sell that one. So there's that optionality again, right? You can, yes, you pay $3.30 to buy a call, but also you receive, okay, you can actually sell options as well and receive money for selling options.
Okay. And that's the price right now, but that might change tomorrow or the day after, right?
Exactly. Yeah.
So that might go up.
Option prices change and the stock price changes, and that's why it's called derivatives, because the price is derived from the underlying stock price, from the price of volatility, the number of days, and yeah, it's all
There's calculus involved in figuring it out.
Yeah, but you don't have to worry too much about the Black-Scholes model. But yeah, I just wanted to introduce you to the idea of car insurance. You've used that all the time.
Yep.
And then the idea of that deposit into a apartment. Or you could say, right, we're buying a ticket for Taylor Swift, right?
Got it.
Putting down a deposit for the right to buy a Taylor Swift ticket, something like that, before they go up in price. So yeah, that is the world of options. It's a wonderful, endless world of fun and opportunity.
Yes.
It's really worth, getting our teeth into, because next week we're going to make our first trade.
Okay. I'll have a think about what I want in terms of options.
That's right. We'll start easy. We'll go with index, but then we can also look at the positions you've already got on with stocks, and then you can look at putting options around those stocks as well.
Very cool. Okay, sounds
Brilliant.
good. I can't wait.
Great stuff. So the floating head of Pega is now floating even higher because of her knowledge in the options market. If you want to hear more knowledge this morning, then we've got the wonderful Axel Rudolph coming up in 5 minutes. See you then.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
CFD trading is the buying and selling of CFDs, or contracts for difference. As a derivative product, CFDs enable you to trade shares, indices, forex, commodities and more without ever needing to own the underlying asset. When you trade CFDs, you trade the difference in the price of an asset from the point at which the contract is opened to when it's closed. As you don't own the underlying asset, you can trade markets that are falling as well as those that are rising. So, how exactly do you trade CFDs? Each contract has a buy and a sell price. Sell prices are slightly lower than the current market price, and buy prices are slightly higher. The difference between the two is referred to as the spread. If you think the market will rise, you would buy. This is called going long. If you think the market will fall, you would sell, known as going short. The more the market moves in the direction you predict, the larger your profits. If it moves in the opposite direction, the greater your loss. CFDs are traded on leverage, which means that you only need a small deposit, known as a margin, to gain full market exposure. So, if you wanted to open a position equivalent to 500 Apple shares, you might only need to put up 20% of the cost. Your profit or loss is calculated based on the full value of the trade, however, which could mean magnified gains, but also magnified losses. So, when trading CFDs, you should always keep an eye on the potential downside. Take care to manage your risk with stops and limits. Visit IG Academy to learn more.
Welcome back to the show, trader friends, and we are live from the trade desk with the one, the only Axel Rudolph.
What an introduction.
So good to have you on because, you know, we were all, you know, in tenterhooks here. Some train issues this morning I heard with people not, I can't, Phil was saying there was traffic.
Trespassing, which obviously is not great on a Monday morning. But I had worse last week. I tried to get home, and home is not far away. And what normally takes me half an hour took me 3 hours.
Oh.
Yeah, no trains, no drivers for trains. It was just awful. And this is the third time this has happened in a month in London. Not great. But anyway, let's talk about the markets.
Speaking of not great, Stellantis is not great. This session, one of the biggest fallers. Many of our trader friends out there asking, me to get your thoughts on this chart. I'm going to show you the reaction on the 10-minute, just to show you the reaction after Tavares stepped down, but you know, he was expected to have done so next year. It's just that he's doing this early. What are your thoughts on this chart?
Well, basically, if you look at the daily chart,
Yep,
why did you hold the stock anyway? I mean, clearly it's in a downtrend. It's been in a downtrend for donkey's years, and it continues to fall. So it's in a downtrend, and therefore I personally wouldn't like to buy it, because I'd like, even if I fundamentally think that a stock is undervalued and longer term a good buy, I want to see some sort of signal, at least short term, to tell me from a technical perspective that the market's going up. Now here what we're seeing, it's going down, and we are currently, I think, even below the low going back to 2001, if I can see that correctly. I don't know, is that the low? What's that low there?
That low is 1124, around mid 2022.
22, okay, so we haven't seen that low then. Okay.
Yeah, it's very, very close though. You're right, it's very, very close to that. So, you know, what does that tell you? And we've got some people earlier on today, some trader friends asking, you know, hey Rich, hey and, you know, would you ever, you know, go in to see, how would you see a bounce? I said I wouldn't touch this stock with a barge pole, because to me it's a bit like Aston Martin. It's got that similar, you know, sound, mood music. Would you look to, how would you look for a reversal if you were?
Well, I mean, basically, I also wouldn't buy it here unless you're a long-term investor, perhaps. But even then, I would probably have a stop, which is below that low you're just pointing to at the moment, maybe a percentage to below it. Because if you go through that support, who knows where it's going to go next? And it could easily drop another 10-15% within weeks. So for that reason, I probably wouldn't buy it. But that's my strategy. I don't try to go against the trend. As you know, I try to catch a trend and trade with it, because that way I've got the odds in my favor. Here, in my opinion, you don't have the odds in your favor. But if you happen to be long and you're still long, you haven't been stopped out, a reversal will probably happen once you take out the last relative high or the high before that. So you go back to, you know, 2 or 3 weeks ago. Maybe those highs here you see on the right-hand side of your chart, yes, these highs basically, if they get taken out on a daily and ideally weekly closing basis, that could indicate at least short-term some sort of stabilization and maybe a reversal. But unless that happens, look at the candles. They're red and they're pointing down, and they're heading down even more. So the trend's your friend, it's pointing lower.
That's right. And Axel, his mantra here is do not go against the trend. Speaking of which, FTSE, you've spoken a lot about the FTSE recently. Shall we take a look at that next?
Yes, I mean, here with the FTSE, what we saw is very interesting, because last week, I believe, we went down to 8,000. It was a really important support. Psychologically, it's a round number. And if you wanted to buy it there was support at the August low, just below there. But that was your stop, basically. If you had gone through the August low, you would have been wrong on your view. This uptrend we've seen over the last year would have been avoided, and what we're seeing instead is a bounce off that support area. So here we are above support, and therefore you can buy it. But if you fall below support and close below that, then the odds are that that trend is likely to continue, as we saw on the previous chart. So right now, where are we at with the FTSE 100? We are back where we were before. I mean, look at this sideways trend we've been in for what, 4, 5, 6, 7 months?
Yes, it's a real sideways trend channel, isn't it? I mean, we have a question from Andrew McKilvey, and he's asking me to ask you if you look left on the chart, and how far back left do you look for reversals?
Well, I don't look for reversals per se. What I look for is support and resistance. So I look at previous highs, previous lows, and ones which are older. So if you look at lows going back or highs decades and years, those are far more important than the ones you saw a week or 2 weeks ago. So I looked to the left of my chart to see where those support and resistance zones are, because it's not just a level, it's an area. And you have a cluster of previous highs and lows which are close together, as you can see here on the FTSE 100. That tends to act as a resistance. If it's the highs, if it's the lows, that tends to act as support. And here on this chart, what I would have done, because we're in a sideways trend now and have been, I believe, since April of this year, I would just look at those highs on the chart on the left. I wouldn't go back to, you know, the year before, 2022 or 21, because that's no longer relevant. Except that high you've got on your chart here, going back to 2000, no, on the left, that one there, no, that highest high, that one there, that acted as support just last week or the week before. So these previous highs, because of inverse polarity, can act as support if you retest them from the upside.
Great. And also with this sort of channel formation sideways, just reminding our trader friends that also you could look at an option strategy, as we spoke about earlier on the S&P as well, if you wanted another way to express your trading position. DAX is another interesting one. You wrote about this recently. A lot of our viewers follow your weekly trade of the week.
Well, the DAX was really interesting. Here's basically where on Friday we tested the all-time high, which we made in October, and we came within a few points. And it's not surprising that today, after Thanksgiving, you know, more volumes coming back into the market, because since Thursday of last week, we haven't had really that much volume. So buyers could drive European markets higher very quickly, like we saw in the DAX on Thursday and Friday, without US investors selling, for example, the European markets, because they're worried about France. We can speak about France in a moment. But here, what is interesting is technically, we're testing that high. We're short-term failing there, but if we were to break above that October high, trends your friend, we're probably going to head towards 20,000 on the DAX. And right now, as long as we stay above the lows we saw 2 or 3 weeks ago, that trend is still pointing higher.
Brilliant. Andrew McKilvey saying, thank you very much, Axel, for your explainer on the FTSE, and also how far left you look and the price action that you look out for. Got away from the numbers. Hey, away from the numbers, asking for further indications of where you think the Germany 40, or rather the DAX, is going to head in the coming weeks. I like that term you used here, short-term reversal, but if we break above that point. But do you think the DAX, looking at where it's come from, do you think that we can continue to march higher, and for how much longer?
I have no idea. Nobody does. But it will very much depend on several factors. Obviously, the US markets will influence us to a large degree. But today, for example, if the French government were to be toppled, that would be negative for Europe, because it's the second biggest economy. And therefore, it will probably also have a negative impact on the DAX, because international investors will probably take further money out of European stocks. And even though they've already underperformed to a large degree this year, they may continue to do so in the short term. Having said that, if you look at seasonality, you tend to get outperformance in the last 2 weeks of December, and maybe we can have a sideways trading range here. But if the US markets continue to make all-time record highs like we saw again last week, then the odds are that this trend is going to continue, and the DAX will probably head towards 20,000. I think around that number, it will probably pause short term, because it's a run number, and markets quite often pause around these for a while at least. But here right now, I mean, short term, I would trade the break when or if it happens. Right now, you can trade against that high if you are a counter-trend trader, but you have to have a stop and reverse order in place in case you're wrong, because if it makes a new all-time, that's likely to continue you to just head higher.
To 20,000, the next round number. That's right. So you heard Axel talk about the DAX here, away from the numbers. Here you go. And another question coming from Arish about gold. We'll get to that in just a second. Let's have a look at the CAC, shall we?
Yes, so basically what's happened here is Marine Le Pen, so our French right-wing party head, basically threatened Michel Barnier that if he didn't incorporate into his new budget plan some of her ideas, then she might actually topple the government with the left-wing leaning parties in France. And if that were to happen, obviously it would be very bad for French yields. They would probably shoot higher. Last week, we had French yields at some stage shooting above yields in Greece. So the risk perceived by the market was that France, at the moment, at least short term, looked to be more risky than investing in Greece debt. And that was quite surprising to a lot of market players. It didn't last for very long, but still. So you can see here on the chart, we are very close to the lows we made in August, and we held above that support last week and bounced off it. But if you look at today's chart again, we have another red candle forming as we speak. And that candle, if I don't know whether that's the case yet or not, but I don't think so. I haven't seen anything just yet when I came into the studio. But if the French government were to be toppled, this could just go down very quickly, even further. And you can see here again, the trend's your friend. It's pointing lower.
And you know, she's dead serious. I mean, I know your wife is French. What is the mood music on the ground about this? You know, toppling. She could topple his government within 48 hours. How real is that threat?
Just as real as the French, as the German one was a few weeks ago, where we, in the end, did have, well, the government was forced to go to elections in, I believe, March of next year, isn't it? So, yes, it's
Why on
pretty
earth
real.
it's such a long wait? I don't know, you know?
Well, the Germans said that they needed to print paper. And they couldn't find enough paper for the ballot papers, but that's a quite strange one. But yes,
strange.
So yes, I mean, the risk is very real, but it's a 50-50 bet. Do you want to play 50-50 bets? I personally don't. I want to wait for the market to react. If it moves very quickly, I could have, for example, a limit order in, I get triggered, I have a stop in straight away, and then I let it run. Same if it reverses to the upside. Trading it now is a 50-50 bet. I try to trade with better odds.
That's exactly right. We always try and help you trader friends get positive skew. That's what this show is all about. Just taking a look at gold as well. We have a question from Arish, another fellow trader friend that trades gold a lot. And he is asking, if you have a view, he says, too early to ask for gold view for 2025, given Trump's strong dollar policy. But what does this mean? What does Trump's strong dollar policy mean for it? And he wants me to put that to you, Axel.
Well, first of all, you can find all of my articles, which I've written on things like gold and other markets, on our channels. And also, if you just Google them, with my name, you'll find what I think about gold. Long term, if you go onto a daily chart, Angeline, you can see that we are in a very clearly defined uptrend. We went down 8% a few weeks ago, but if you look at it now, if you zoom out, Angeline, to the last 3 weeks or so, you can see here that we're just trading sideways now. So the question really is that the end of the uptrend? Right now, we're just consolidating above those highs, below those highs at $2,800 or so. If they get taken out, and I believe they will be at some stage, because I've got a Fibonacci extension target, 268.1.8 Fibonacci extension target up at just above the 3,000 mark. So I think next year in 2025, we will hit that level. That is my view, but that view might get changed if we fall through the recent lows. If we go below $2,605 per troy ounce, we might see a consolidation phase with a bearish bias first. So it really isn't about forecasting. I don't like forecasting long term because the price changes constantly and it changes your trajectory. So it doesn't really make much sense for me to say, oh, you know, my end of year gold target is at 3,000. I know everybody loves to do that. I don't really believe in that. What I do look at is what the price action is telling me. And right now we're trading sideways between 2,800, 2,600. If it breaks out of that range, it'll become very interesting again. And I still favor the upside for the time being.
Me too. And that's right. Trader friends, you heard from Axel, who's totally right. I don't like those price targets that banks and, you know, analysts put out as well, because, you know, especially if they're really far out targets, you know, things can change, and we've seen them change, you know, on a sixpence recently. So lots of viewer friends here saying thank you very much. Arish saying thank you. He'll check out your article. Big fan of weekly trades. Thanks very much, Arish. Adam DeLu's also listening in, one of Lynchy's clients, saying thank you very much for that. Which brings me to my second favorite financial instrument, oil. WTI. I've been watching this closely because we've got this OPEC Plus meeting coming up this week.
Yep.
This is just a minute chart because I was looking at that earlier, but let's have a look at the daily chart there. Where do you think this is heading? Trader friends out there today, lots of them who trade oil.
Well, let's look at it together. I mean, what are we seeing? We're seeing a converging range. So the volatility has decreased over the last few weeks. Over the last week or so, you can see these candles being shorter and shorter, so volatility is decreasing even further. The Middle East ceasefire last week led to a rally. Then the fact that, unfortunately, it wasn't always adhered to by either side, Israel or Hezbollah, made the market worry again. Now we've got OPEC Plus. It will very much depend on what that gets, what sort of decisions they will make. But more importantly, what our view is on China, also the world's largest oil importer. And China, some people now seem to think that perhaps with all the stimulus packages we saw a few months ago, it may grow again to an extent that we would like it to see. But then again, if that's not the case, the oil price might actually fall even further because there isn't the demand. So right now, fundamentally, we're between a rock and a hard place, in my opinion. Technically speaking, what I look at are the lows that we saw just a couple of months ago. As long as we stay above those, we're probably just range trading, and those lows, sort of $68 or so on WTI, I believe. And we're just trading sideways. So not much really going on here. How would I trade it? Today, if you want to go long, you put your stop below Friday's low, because that is the last reaction low. So as long as we hold above there, maybe we can see a bounce back, because in this area, we've bounced back several times, as you can see on this chart, within $1 or so. If you want to go short, well, you know where your stop is, probably above Wednesday's high, short-term speaking, because that is the last reaction high from the high we saw last week. So it really depends what your strategy is. But right now, we're just in a converging range, which, if you look at Bollinger Bands, you will see those bands tightening. And that could indicate that we might see a high volatility breakout with OPEC Plus later this week. I don't know which side, though.
Bollinger Bands, not Bolly. Rich was, you can't hear him, but Rich was in there going, Bolly. That is amazing stuff. Thank you so much, Axel. We've got Adam Luz Irish away from them is all saying thank you to you for your very specific, detailed answers. What's the rest of your day looking like?
Very busy.
I hear you've got a nice lunch coming up.
I've got, yes, client lunches, but I've also got client meetings. I'm going to do Trade of the Week, which I haven't looked at yet, so I need to obviously come up with something which works.
Are you doing that right after the show? Or?
No, I'll write an article and then I'll do that. But
nice.
Yeah, it's a busy day.
And lots of our viewer friends asking, what is the article going to be? You're going to be able to find this online, so...
I don't know yet. I'm trying to find things which look technically interesting. I've just done last week, and Chris Beecham and I, we've done a lot of our forecasts for next year and end-of-year forecasts and targets like that. Right now, I really don't know what we're going to cover.
Great. And on that note, we are going to check in with Axel later on. For those of you that follow me on Twitter, I will post Axel's piece so you can find it easily.
Corporate earnings reports are quarterly reports that reveal the financial results of a public company. They include valuable information such as revenue, net income, and earnings per share. Investors can use corporate earnings reports to gain insight into a public company's performance. They help investors decide whether it's time to buy, sell, or hold on to shares. So, how do corporate earnings reports impact trading? 1. They affect market indices because indices are made up of publicly traded stocks. Index values go up or down based on stock price movements tied to company earnings news. 2. Corporate earnings reports can signal a healthy or unhealthy economy. They could influence central bank decisions on interest rates and monetary policy. 3. Unexpectedly positive or negative reports have the potential to induce volatility in the stock's price and prompt activity in the market. 4. This surge of trading activity could result in more liquidity. It becomes easier to enter and exit trades when there are more active buyers and sellers. However, increased volume can also introduce greater unpredictability and price swings. 5. Positive reports can bring in foreign investment to a country's market. Negative reports could make foreign investors less interested and reduce their involvement. 6. An earnings report has the power to sway how investors feel about a company or the market in general. How an earnings report impacts the price of a stock depends greatly on what investors expected. If earnings exceed estimates, the price tends to go up. If earnings disappoint, the price often drops. Meeting expectations is key. Even good news might sink a stock if investors hoped for better news. Likewise, a stock could jump if bad news wasn't as bad as predicted. So, how do you trade corporate earnings news? The challenge is to work out how you might react to news that will thrill or disappoint investors. Have an action plan in place for earnings that exceed expectations, or earnings that might disappoint. There is also a chance that the earnings might be exactly what the market expected, and there won't be much price movement at all. Keep in mind that the market can be unpredictable, and these changes can happen in a flash. Option strategies can allow traders to trade big price swings in either direction. Strategies involve buying both call and put options on a stock prior to the report. Call options can protect short positions from rising prices, while put options can protect long positions from falling prices. Finally, it's essential to have risk management practices in place, such as an airtight trading strategy, stop-loss orders, and portfolio diversification. Consider bird's-eye view factors like industry trends, the health of the economy, volatility, revenue growth, and trader sentiment. With preparation, agility, and risk management, you're on your way to trading corporate earnings news effectively.
Hi, I'm Sean Mearson, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill, whether you're starting out or just looking to level up. We got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey, learn to have confidence to trade, and make informed trading decisions.
Welcome back. So straight into market measures we go. Today we're looking at how your capital allocation impacts your P&L volatility. Right, so let's dive in. So when we scale up, we observe larger profit and loss changes for the same positions. But how does volatility respond to this increase in scale? Also, how does volatility react to different management strategies, such as exiting at 50% of maximum profit or at 21 days to expiration? So to understand this, we analyze the volatility of a portfolio of Spider, 45 days to expiry, 1 standard deviation, 16 delta strangles, with a constant capital allocation of 25% of the total asset value at all times. The positions were either held to expiration or they were managed at 50% of max profit, or option 3, they were exited at our usual 21 days to expiry. Now, on average, exiting at that 21 day to expiry generates the highest return and the lowest volatility. So this offers superior results compared to the other two strategies. So as you can see,
there we are.
Angeline's in control today, jumping ahead. You see to get that much lower volatility and higher return, it's the double bubble there, and definitely the optimal strategy. So managing winners can generate a higher return compared to holding to expiration, but does not control volatility as effectively as the 21-day to expiry approach. There you can see that managing those winners gets you 0.042, slightly less daily return, but the volatility goes up hugely.
And that 21 days to expiry is 0.05%. So that's kind of like the sweet spot, isn't it?
Yeah, definitely. So next, we want to understand how capital allocation impacts portfolio volatility. So within the same portfolio, we increase the committed capital usage from 25% to 35%. Let's see if that makes a difference. After that increase, the volatilities of all three strategies went up. Exiting 21 days to expiry yielded the best results in containing the rise in volatility. It was only a 0.4% increase. Now, managing winners at 50%, however, achieved a greater jump in profitability. So that's those two now almost equal, isn't it? Almost, but yeah, much better. So better profitability if you increase that capital allocation from 25 to 35%.
So here are the key takeaways. Regardless of capital allocation levels, exiting at 21 days to expiry consistently shows the best ability to control volatility among the three strategies. And when scaling up, the 21 days to expiry approach results in the smallest increase in volatility, whereas managing winners at 50% experiences the highest jump in profitability.
So this has been a real game changer for me because I've always ran options to expiry before. And even when I was trading for the bank and the hedge fund as well. So one boss that I worked under, Fabrizio Gallo, he would constantly trade his options positions. And I didn't. I just bought them and held them, or sold them and held them to expiry. So today, I was going to do it on Friday, but I ended up not having the time to. So today, I am rolling all my Decembers to January expiries, because it's spot on that 21.
I'll also never remember my first options position, because Frank was in your seat. And
Was that the first one?
Yeah, and he did it for me because my account wasn't set up yet.
I
And
remember
he said,
what it was.
off you go, Spider. And then I then said, and then you don't look at it for another 21 days. He was like, yeah, that's done. And I'm like, and he looked at me. I was like, I feel really uncomfortable about this. You know, I normally look at something, 16, 24 times in the day, and I just want to put it to bed, and I just want to put it to bed, and
It's a lot less stressful. It's a lot less stressful.
And he said, you're coming out in a rash, Ange. In a rash, Ange. But it's a real different mind, right?
Yeah, you were short the 5,900. Short the 5,900. Yeah, you were short the 5,000
dates, right?
Yeah.
Mindset when you come to
50 puts, I think.
Yeah.
Calls. And at the right time, there was a little dip in 50 puts, I think.
Yeah.
Dip, and then you managed to get out.
Yeah.
750 puts, I think. Remember, because you closed it at the right time.
I was perspiring.
Yeah.
Really, I'm not used to. So that's watching, by the way, the Pega sort of reaction to the options. It's really so that sort of time frame. Getting more used. Watching, by the way, the Pega her early sort of into the options, and we'll get there. And I love how she's got so much enthusiasm and so much interest in it as well.
Yeah, and to acknowledge as well, being able to actually. Yeah.
Yeah.
You know, I think options will be to what, you know, her great and then when we come back,
Yeah.
right, this week, including that big, we're going to look at everything. Quick break, and then we're
New morning show. Trade live with IG's new morning show. IG's new morning show. Trade live with IG. Covering all our UK product offerings, OTC and exciting new products. Starting in join us every weekday from 7:30 a.m. for exclusive insights from our trading concepts curated by Live. Global guest appearances. September, join us every weekday. Insights from our trade desk, expert trade, global guest appearances, and up-to-the-minute market updates. Ends at tastylive. Market updates from casual chit-chatters and loads of viewer interact depth analysis. We've got you're a seasoned professional or just starting morning covered. Live on IG, just starting out, there's something for everyone covered. Live on IG. You're a seasoned professional or just starting and kickstart your trading day. Starting out, there's something for everyone. Live with IG.
This is a method of evaluating assets. Should be. It's fundamental analysis. Asset has a real fair value. It's what their prices should be. Markets will naturally correct to reflect these. It assumes that markets will naturally correct these fair values over time. Currently underpriced, or it assumes that markets will priced or overpriced. The aim is to discuss now, unlike a technical analysis that focuses on price charts. A detailed fundamental analysis would look at everything that could drive future price movements. The technique is most commonly used to scrutinize the price of shares, where annual reports, industry of an overall assessment. However, fundamental analysis can be used to review the price of an asset. A commodity like oil, for example, could be evaluated on the basis of economic data, regulation, brand recognition, geopolitical factors, and technical specification, among other factors. But while fundamental analysis is often said to be more comprehensive than technical analysis, it may not give you the full picture. For one thing, it's generally only useful for identifying long-term trends, whereas a technical analysis can help find short-term opportunities. For this reason, it's often a good idea to combine elements of both types to get the most accurate view of a market's direction. To learn more about fundamental analysis, join IG Academy today. It's completely free and gives you access to dozens of trading topics.
Hello people, welcome back, and this is the section where we take you through what's coming up in the coming few hours and also in the coming week.
I'll tell you what we haven't had a quick look at is our all sessions. Have a look at
Let's do that first.
Is moving. So it's Nvidia down 1.2% there. Upstart down 5. Ben Buswell, are you in the house? Down 5%, your favorite stock. What is going on there? We have on the upside Tesla up 1.6, and your favorite Moderna up 90 basis points.
Moderna.
JD.com, Taiwan Semiconductor up 2.
But also take a look at all the Baidu, also the Coinbase. A lot of those are up today, which is interesting given how we had a slow start at the beginning. eBay also up slightly on the losers list. Tilray, interesting, is the third biggest loser there, those of you in that space. Mara Holdings is also down, so quite a mixed day for crypto-related type currencies. You haven't been buying enough trainers because Nike is down 0.5% there as we come up to the shopping season.
Oh, Disney up to 117 now. Wow. I wonder if that's worth looking at selling some calls in. Disney at 117. That's what a great performance. Let's have a look at that since numbers. And you can see when a stock is continually disappointed, but then suddenly it has a decent set of numbers. Let's have a look at that on the daily. There we go. What a stock to have there.
Do you think
20% move.
Do you think that's enough to entice you in?
Well, no, sorry, selling calls.
Oh, right, okay.
So I think that's one to sell a strangle on because it's good numbers means it's not, you know, in my opinion, it would be relatively safe around 108 to be short puts there. And then, you know, maybe at the 125, would that be too far for now? That'd be right at that breakout level from 123 is the top of that chart.
Yeah.
So yeah, I might have a look at that today. 123, 108 strangle, selling that.
Oh, Adam making a comment about your haircut. He says, looking fresh, rich, haircut over the weekend.
Richard Ward, Sloane Square.
Ah!
So my hairdresser is a big Italian guy called Adolfo. And Adolfo is king of Chelsea. So he's been around for about 25 years.
Does Adolfo slap you around once he's finished and puts that hot towel on your face?
You're thinking of Turkish bar. That's not very Richard Ward kind of vibe going on there. This is where Princess Diana used to go and get her hair cut.
This is where you get like offered champagne and in the morning. All right.
It's a wonderful, great place. It really is. But yeah, it's also where Kate Middleton, where everybody went before the Middleton wedding, to all the royal family.
Nice.
To get prepped.
So
when I go back in and ask for a short back and sides, you know, then
nice.
This is what I get.
So clearly you need to go to the royals or one of their milliners then, because you know, Lock & Co near St. James's does all the hats, and they're one of 5, I believe. And I went there and I said to the founder, I said, it's really lovely, but I'm really not a hat person. He was like, I can find a hat to suit you. Just leave it with me and spend an hour with me, and I guarantee you. And he took me upstairs and he said, which one do you like? I went, that one. No, you can't have that one. That's Kate's. Okay. How about that one? No, not that one either, because that one is being designed for someone. Okay, which hat can I try on? But you should go. They have an amazing showroom. And given your haircuts done by, you know, those that serve the royals, you might want to go to Lock & Co as well. Lock
& Co. Got that one in.
Yeah.
So, Adam, thank you very much for noticing, because my girlfriend didn't.
I didn't notice either.
Yeah.
I didn't notice
Angela
either.
Didn't notice either. So, you know, nice to know that the people closest to you. Right, so we go on to what we expect from the economic calendar this week. So we can take a quick, brief look through the 2-year Schatz in Germany. That's what my darling girlfriend calls me, mein Schatz.
Aww.
So named after the 2-year bond, since she's an economist. Right, we've got the Jolts openings on Tuesday there. So that's going to be important. Wednesday, we start to get... Oh, sorry. First of all, today I missed, of course, the ISM manufacturing. So today is actually quite an important number. 3 p.m. Get that on your watch list today, because we're expecting 47.5 from the manufacturing PMI, a 47 number in employment, which I just have a funny feeling that might come in a little bit light. New orders at 47.5, and then prices astronomical up there. The only thing above 50 is prices. That's a concerning feature there. So that's our Monday today, 3 p.m. Then we go, straight through to Wednesday, and we're looking at ISM for services at the 55 level. We've got factory orders. We've got the Lagarde, Christine Lagarde is giving a speech. We've got also Powell. So Powell and Lagarde speaking on Wednesday. Always interesting when they're both on the same day. Definitely ones to watch there. We've got the Beige Book ahead of that as well. Then, Ange, Thursday, initial jobless claims is the only thing of note. Do we have anything in the UK? Car sales.
So I have a feeling, is that a song? There's another song. Sometime I got that feeling. US jobs expected to rebound. And I think that we are going to see a number that kind of gives Trump that kind of like, yeah. But
the feel-good factor.
Yeah, the feel-good factor. And I think...
Will the markets like it, though?
Well, I think, you know, jobs have disappointed for some time. And I think now it will rebound slightly. And what's also perhaps
what's your thinking
more
on the number?
Interesting. What is the, remind me again, what is the expectation?
195 expectation after 12,000 because of the hurricanes last month. So if we can just pop that back up, please, Terence. 195 is the expectation. 4.2. Now, I don't think I've seen 4.1 mentioned. So 4.1% unemployment, average hourly earnings of 0.3 or 3.9 for the year. And then the U6 unemployment rate of 7.7%. What do you think that payroll is?
I think it's going to be a stronger than expected number in
back into the 200s.
Yeah, 210, 220.
Right. Yeah, because I think the rolling average must be down in the mid 100s now. So that would be back above the average. Would that lead to an unemployment rate of 4% as well? If we go back to 4% unemployment and non-farms are above 200, we are not going to be seeing the Fed watch stay at that 67% chance of a cut. So it's a big week this week. ISM today, ISM services on Wednesday, and then non-farm Friday. Don't really have any companies reporting, do we? It's a slow week. We've got
well, we've got a few. We've got a few. I mean, they're not A-list, has been said. You know, right? It's not A-list. But we have got Salesforce on Tuesday. We've got GameStop, TBC, but third quarter, I think sometime midweek. I think earlier during the show you were saying that you think it's this week. I think it's Wednesday. Dollar Tree as well. Those of you that trade retail, I quite like retail, especially this part of the year. And Dollar Tree third quarter numbers come out midweek. They give an early indication, Rich, of how people are feeling in the US. And Dollar Tree is, of course, the lower end. And if you see a good number from them, it could mean that potentially the lower end of the consumer space is going to be doing well in the festive season. As we all know, with the Americans, they like buying stuff. Doesn't matter what stuff it is. So there will still be things bought this festive season, just that I think they will go towards the cheaper end rather than the more expensive end.
Oh, Monkey Man giving us clues to his age here. New Orders, great 90s band. Was that? I remember New Kids on the Block. That was my first ever LP, was New Kids on the Block.
Is that the 245 song that keeps going on in my head? That 245 or something. And you said 245 earlier.
I know. Now that you've sung it, I know exactly what you mean.
Where is it? Where is it from?
Brimful of Asher.
Ah, there you go.
45.
So Monkey Man's song is which one?
Finish yet?
It might be time to finish. 57. And then of course that non-farm payrolls on Friday. But people out there also bear in mind, we have 3 other things out there to watch out for. One is what happens with French politics today, right?
Tricky.
Which could mean tomorrow will be interesting for the CAC 40. Number 2, we have OPEC Plus this week as well. I am poised, putting my levels down for the WTI chart. You saw Axel talking about just now, don't be a fool, don't jump in before your lines tell you where your entry and exit should be.
Did you do any trades with Axel?
No, because I was so entranced by what he was saying that I was typing it into the chat. I think a lot of trader friends were wondering, hey, why is Ange looking over there? Because I was typing it into the chat and relaying Andrew McKelvey and Away with Numbers all their questions as well. No, but I have got a trade on with Volkswagen that's now up money. And I did a pivot. It's always really nice when Rich gives me a break when he does Pega, because it allows me to pivot. And so earlier you saw me say, I'm going to take a nibble and I'm going to short Volkswagen. And when he was with Pega, it allowed me then to pivot because it breached the line going back up. So I pivoted and am now, and it's just a real nibble, half 50p a point there, and it's up money because this was just a test. And now after the show, I'm going to add to that leg because it has continued further on the 10-minute chart. Adam Deleuze is likely to say, I only look at the 4-hour chart, but you trade longer in terms of your duration than I do. So this is where we are at the moment with Volkswagen. Right. So was that my second? There was a third one.
We've got, with 20 seconds left, we have a request from Neil Cavendish. So this is new order. And very, very apt as well. Blue Monday, seeing as the colourist shirt I have on.
Oh my God. This is a great tune, Neil Cavendish.
How do you feel to be long Volkswagen? Have a wonderful Monday. Watch out for that ISM at 3 p.m. I'm going to go and roll all my tasty trades across to a January expiry.
I'm going to put on another leg on Volkswagen. Thank you, Neil, and all you trader friends out there for a wonderful Monday.
Ring the alarm. Hey, ring the alarm. Boys, turn up the charm. Listen up, y'all. Get out the damn stall. It's the last call. Hey, the last call. The last call. The last call.
Tomas, we are back, my friend. You know what that means? Time for the last call here at Tasty Live. E-mini S&Ps, as the world has intended, up $28.50. NASDAQ up 70. The Russell is the only weakest one. It was the strongest yesterday. It's down 20. You remember this morning, the Russell and the Dow was down. The Dow has reversed, now up 120. Even the S&Ps, if they close here, Sadnov, it'll be a new closing high. What say you? Yay, yay. Clapping. I love it. Volatility down 7 cents. Bonds down 12. Let's just call them mid-priced at 118.03. Bitcoin taking a little bit on the chin, down 4,000, just about 3,800 or so. And I know coin was down around 16 or 18 before. Wow, down 21 now. Man, I don't know who got short Delta in there for his option trades today, but that would be Tony Batista. That is correct, Sadnov. Another little win for the bat.
I think I made the call on Sunday night that it was time for these things to sell off dramatically. It's only 10%. So that's kind of what I thought, at least 10%. So we'll see. The Ginsler bump is done. And now they're going to have to fight their way back. They'll come back. They'll get back to 100. But this
to 100,000. You talk about a Bitcoin?
Yeah. But they had everybody so over their skis. It was so ridiculous. Now they're getting back to kind of. I mean, I know 90,000 is not exactly what we call normal, but some of these stocks, I don't know how high coin got, but they've taken a little wind out of the sails.
Oh, for sure. I mean, coin looks like it traded all the way up to, I don't know, like a high of around 350 or something like that, 340, 350, and it's 290. It's giving up about $30, $40 off its highs.
Yeah. So, I mean, that's kind of reasonable, right?
Sure. More reasonable than going in one direction, but it's leading the market lower with MSTR, you know it as MicroStrategies, down around $60 or just about 15%. Humana down 8, Reddit down 7 at 134 and change. Carvana, which was a darling of the market, down 6 right now. And General Motors down $5. That's a big 10%, 9% move in General Motors. SMCI, after catching a little bit of a bid last couple of days, is down $4 or 11% also. On the upside, Sadnov, while you're looking at Lilly, it's been up all day, up 34. Costco up 9 on the rumor that you will be getting your apple pie there, and Microsoft.
No. I don't do apple pies.
You don't do apple pie from Costco?
No. Cherry only. I mean, I did pumpkin just because you gotta get a pumpkin pie, but I don't eat pumpkin pie. I got cherry.
How can you not like an apple pie? An apple pie is beautiful.
I mean, I can eat an apple pie. I would prefer something else with berries. I prefer berries over apples.
Is a cherry a berry?
Close enough.
I don't know if it is or not, but let's find out.
Close enough. I got some pie filling anyway. Maybe I'll make a pie.
You're going to make a pie.
I kind of feel like it.
Sadnov, cherry is not a berry.
Really?
That's right. Sorry for that. Wait, you know what we do? You know what we do from now on? We don't say you did something. We just wrong. We just say it the right way.
Wrong.
That's the way we do it, Sadnov.
It's a hanging fruit.
We're just doing a little fact checking on you.
I might just make my own cherry pie. You know what? I got cherry filling. I might just go the whole.
Cherry filling from a can.
No. I bought Door County cherry filling. This is special.
No. I bought Door County cherry filling from a can.
No. From a jar.
From a bag?
From a jar.
From a jar. That's my man. You know what? I gotta come down on Wednesday. You want a Door County cherry pie?
No, I do not want yours. I got my own.
I'm locked and loaded. I got a place here that sells them.
No, 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 no. I am locked and loaded. No, 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 no. No, I got my own. And plus, I like making my own stuff.
You know what? Seriously, sometimes, never mind. I don't want to get Beth mad. I don't want to get Beth mad. Anyway, Sad, look, how was your day today? We talked a little bit about the market being relatively slower today. I think we had a slower day, but good volume on the E-mini S&Ps. Over 1 million cars. It's not bad.
Yeah, I'm actually kind of surprised. You know, I thought this week would be slow, and the last 2 days have been anything but slow. So, you know, this is another example of kind of you never know.
Yeah, you're right. You never know. But it's been pretty steady and solid all day long. I mean, we've been up 20 handles for most of the day. I know at the end of the day here, we're catching a little bit of a bid.
Yeah. I mean, I thought earlier today they had a chance to take them a little bit lower, and they absolutely wasted that opportunity. They had them up maybe like, you know, 7, 8, 9, 10 after being up 20 something early on, and I thought, okay, they got a little bit of a chance of maybe doing a reversal. But once they rallied on around like 10:30, 11, they never even downticked the rest of the day. Not even nothing.
Yeah, they never look back. You're 100% correct. And I was getting good fills. I thought I was getting good fills this morning. I mean, I was getting filled.
I think it was pretty liquid. I think it was pretty liquid all day. To be fair, I think the fills are really good. I think we've entered into an era right now where the competitive marketplace for high frequency firms to get scale is so great that I don't, you know, people used to write to us and say, well, Friday's a dead day. It's a half day. I think that it's not going to matter one bit of difference. I think you turn these machines on, it's all about getting scale. You do not want, you know, if you're somebody competing with Citadel, you don't want the orders going to Citadel. If you're somebody competing with, you know, IMC or Susquehanna, you just want the order flow coming to you no matter what. And I think these firms are willing to take it at basically cost. So I don't think it's going to matter really ever again, unless volatility gets out of control. But I think for now,
out of control to the upside, you mean?
Yeah, out of control to the upside where you can't hedge anything off. But I think right now, all these markets are so tight. I mean, this is, you know, we've said it 1,000 times on the show, and I think the rest of the world's finally catching on. We've been saying it for 14 years now. This is the reason, you know, I mean, there's a lot of people that are new to Tasty, but about 13, 14 years ago, people would be like, why are you guys defending high frequency traders? Do you know how many arguments we had? Do you remember we couldn't even get some of the exchanges to come on? They're like, why are you defending high frequency market making? Why are you defending, you know, all these firms that want to step in front of the exchanges and participate in order flow? And our answer was always the same, because it benefits us, the customer, it's a dramatic benefit to the customer. The markets are tighter, they're more efficient, we get better fills, everything gets price improved over whatever it used to be. The exchanges stink on their own. And we argued this, and people would, like, you know, they would call in, they would write in, they would fight with us professionally, you know, and say, you guys are off your frickin' rockers and you're sending a bad message. And we're like, you don't trade. Like, people that think they know don't trade. When you trade and you see the fills you're getting back, you know, you do a 2-lot in some stock and you get filled a penny around mid price that used to be a quarter, you know, and you're like, what the hell, you know, and you get filled, you know, on 50 or 100 trades a day, and you're getting filled 1 penny, you know, a half a penny around mid price, whatever it is. You're like, what the hell? And it's exactly what's happening. And it's been happening now for, you know, that's why the volume has crept up so much. And that's why the whole game of finance has changed. And wait till we launch in a couple of weeks, when we launch the new small exchange, we're going to do something that's never been done before, which is eliminate the bid-ask spread. I mean, we're literally eliminating
it's almost
the
become a
bid-ask
pick 'em market, right?
Yeah, we're giving you a pick 'em market. We're eliminating the bid-ask spread. So how can anybody complain because you get to buy it or sell it at one single price?
Yeah.
So, you know, I mean, yeah. Well, what are you going to argue
couldn't think of anything better, right?
Right. We're going to change the dynamics of everything. And so, you know, listen, I mean, who knows? Maybe people will say, well, what's the catch? I don't know. I'm dying to see myself. But Anyway, I guess the point is markets are better than they've ever been. Anyway, there's no earnings plays tonight, right? Just so I mean, there's CrowdStrike.
My Taiwanese sources, my friends, have come up with a little something for you, Sadnov. We've got a few. Are you ready?
Go ahead.
Dell.
Oh, Dell. Hold on. Do I have a Dell position?
I don't think you do. It's not one that's been pretty.
No, and I do not like trading Dell. Sam, I do not like Dell. Dell is, no matter what happens in Dell, I mean, the stock's back to 140. After the last earnings, it got down to like 110-ish, I want to say. Maybe even lower, maybe 100 or something. It got really low last earnings. It got way under 100 last earnings. Now it's back to 140, almost near its highs. I find Dell incredibly hard to trade. It trades by appointment only. I know the volume in there is 5 million shares, which is not bad, and the option volume has a couple of hundred on each line, but I find it a very difficult stock to trade personally.
It's got a decent IV rank too. But
it does.
Yeah, I would agree with you.
I wouldn't fault anybody for trading it. I am not going to trade it. I just find it very difficult to trade. What else you got?
Crowd, CRWD.
I find that also like 2.5 to 3 stars, but I do trade it because it goes all over the place. We have a very small position in Crowd. I'll tell you exactly what we have on. We are short the 300 puts and the 460 calls.
In Dees?
In Dees. Now, before you say, wow, that seems kind of wide, we're $100 away on the calls. We're $64 away on the puts. They trade for about the same amount of money. It's a delta neutral trade, but there's huge call skew in there. But this stock has moved. The last earnings cycle, it moved $100.
Yeah, I'm looking at that right now.
Yeah, so don't, this is a stock.
All right, I won't make fun of you. It's time to be thankful, and I'm thankful you're here on the show. That's all I can say. This is my Taiwanese source Peter who's giving me these. Workday, WDAY.
Another 2.5 star. WDAY. Haven't traded in a while. Only 2.7 million shares traded. $270 stock. This is very difficult to trade. I would suggest just be careful if you're trading Workday. That's all I'll say.
How about Autodesk, ADSK?
Worse than Workday.
How about JWN?
I mean, Autodesk, yeah. Autodesk, you can't. It's almost untradeable. JWN is
Nordstrom, you're one of your favorites. Nordstrom down 43 cents, IV rank of 52.
Yeah. A stock we don't trade that much, a stock that I feel like has been between 20 and 30 for the last 25 years. It has had a nice rally recently. I'm going to pass on Nordstrom rack. I'm going to pass on Nordstrom, not the rack. Love the rack.
You never pass on a rack.
No.
How about PD? That's the last one. I don't think you care.
PD, what is that?
It's not PDD, which is completely different. I don't know. PagerDuty. All I'm telling you.
I do. No, I'm gonna. I don't know what that is.
There's really no markets in it.
Yeah, so I'm only gonna trade CrowdStrike because I already have position on in there, and I am working my way back to even in that stock. I'm pretty sure. I'm gonna check, but I'm pretty sure I'm down money in there this year because I got caught on that first move. CRWD year to date. No. We're even.
Beautiful.
We're in the even zone. So we made it.
I got to mention Tesla one more time here. IV ranked down to 39 now. Remember we were talking about it in the 70s and it was in the 50s yesterday. 39 today. Tesla really kind of taking back weeks of volatility expansion in the last 48 hours or so.
Yeah, Tesla's one of our biggest Tesla's going to be here, one of our, I think. Let me see something. Yeah, today Tesla's going to be one of the biggest winners, but I don't know. What do you do in Tesla here?
For me right now, I'm nursing a position. I did roll to Jan Sadnov. I took the advantage today. I had the 345, 350, and when Tesla was up today about $3.50 or $4, right basically in between my two short strikes, I rolled to jam. Ended up being a good roll because Tesla sold off a little bit, and the position had a little bit of long delta.
Yeah, I'm a little, well, pretty flat Tesla. I'm going to roll down some calls on the close just because I think tomorrow
You don't
might
want to
be
roll
softer.
to you don't want to roll to Jan. Save yourself a little commish.
I can roll to Jan, I guess. Yeah, I don't know. Yeah, I'll roll to Jan. Okay, good idea. Thank you, sir. May I have another?
This is what I try to do. Bring you good ideas. I mean, if you listen more often, you'll notice that a lot more of them are really good ideas.
Got it. Thank you, sir. May I have another?
You're welcome. You're
roll
welcome.
to Jan. All right. What else you got?
That's it. Gold taking a little bit of a breather today from its fall from grace. It's up $13, relatively small move, but it hasn't gone lower. Silver's up 31 cents, a lot more on a percentage basis, just about 2 to 1 on gold. Nat gas continues its rally. So I'm not in a position on there. Nat gas up another 3.5 cents or so, and your euro turned ever so slightly red, which makes the dollar ever so slightly stronger. That's how we go here with about 9 minutes till the market closes.
Yeah, I actually got a little bit long euro today. Let me just make sure I got.
You scalped some bonds today too, small.
Yeah, scalped some bonds. I got a little bit longer bonds. I sold a bunch of puts in the bonds this afternoon. I sold the 117 puts in December, just because I think the bond little down move today was kind of a little bit of a gift. No, I did not get filled in the euro. I was trying to sell some puts in there, and I thought I got filled, but I didn't.
It's okay. No. Best laid plans of mice and men. You'll be all right.
I think you got to lean long, but I missed it, and I put it in between the markets. They never took my offer. So
how does your position look going into the? I know we still have another day tomorrow and a full day of trading tomorrow, half day of trading on Friday. We will not be on the show on Friday. We will be on tomorrow until 10 Central, just our show playing today. But how's your position look? Are you using a lot of buying power, a little bit of buying power? What's your theta ratio and your delta? And then we'll bring in the boys, Ilya and Chris, after that. What do you got?
I'm a little tiny bit short here. I shouldn't say I'm tiny bit short. Yeah, I'm short delta. I'm definitely leaning, definitely checking my positions here, and I'm leaning short. And I know that tomorrow is traditionally one of the stronger days in the market, right?
Mm-hmm.
In general, if you're thinking about like, what's the most bullish day of the year? They used to say the day before Thanksgiving, right?
Yeah.
I don't know if that's even remotely true, but I'm checking kind of my index positions, and I'm definitely leaning a little bit long here, but some of it might have been the rally in the last, hour or so.
You're leaning a little bit long here?
No, a little bit short. I'm sorry.
Oh, okay. Because even the S&P just rallied 10 handles to be up 35. That'll be a new closing high on the E-mini S&Ps, not on the NASDAQ, and definitely not on the Russell or the Dow, but on the E-mini S&Ps. Oh, I'm sorry. On the Dow, that will be. I apologize.
Yeah.
Maybe on the Russell. Pretty close.
I got caught a little short in this last little rally, the last few minutes here. No about it, doubt it.
Mm-hmm. Yep. Totally understand. Coin down 16, starting off with Bitcoin selling off. A little bit of Hood taking a little bit of a breather, down $1.40 or so. After
it's been on a tear.
It has, and so has General Motors, another one that has been on a tear, and UAL also off of its highs. It's up 9 cents, but you can see there it was up about $2 or so.
Yeah, we tried. It was up, I think, $4 this morning. I think I tried to get short UAL. I tried to sell the 105, 110 call spread today, and we were so close, like a tick away. It was trading like 160. It was trading over 170 in the morning. Then I tried to get shorted at 166.
$1.70 on the spread. The stock traded up to 101.5. You are correct. It was up around $4 or $5 at one point.
Yeah. I missed the spread, and I chased it all the way down, and I missed it again. So I tried to get short UAL. I thought it was ridiculous. Do you know UAL's been up like something like 20 weeks in a row? I mean, like pretty much this entire year. I don't think it's had a. If you look at the weeklies, I don't think it's had a. Yeah, there you go.
I don't want to look at the weeklies. You can't make me.
Yeah, I mean, it's ridiculous. It was the greatest short in the world today. I just missed it. I was mad at myself.
Oh, come
for
on. It
about
was the
an hour
greatest short in the world today because it went lower. I mean,
Yeah, I know.
And by the way, it's still up 2 cents on the day.
I was waiting for a gap up opening though. $4 higher was a gap. I just missed it. I missed it.
You know what? Maybe
Anyway.
I can get some real traders in here. Where's my boys? Do I got Chris and Ilya? I do. I do there they are. Hello, real traders. Hello, welcome to the show.
Hello, real traders. That sounds like a welcome to movie phone thing.
How much movie phone?
Reference movie phone a
That's
lot.
right. Thank you, guys. Thank you.
In the past several weeks, I think it's becoming a little bit of a thing.
Oh, I didn't realize that it was a thing. It's an old Seinfeld episode. You've seen it, right?
Of course.
Oh, okay.
I still remember having to call movie phone back in the day.
Yeah, I never actually used movie phone myself. I just saw it in the Seinfeld episode. But I used to use an app called, and it's crazy, I don't know if you guys remember this, but there was an app called Fandango.
There still is? Believe it or not.
It's still around?
Did recently.
Oh, I didn't even know they were still around. Well, funny little story. So I don't know who owns Fandango now, but the same private equity firm that invested in Thinkorswim, the first investment we took, invested right before us in Fandango. And at a early on board meeting that we had, they go, they were talking about all their crappy investments. And they used to say, the worst investment we ever made was Netflix. But then the second worst was Fandango. And then you guys are the third.
and that was when Netflix was not Netflix.
Netflix was like $9, and they invested like $250 million in Netflix at at $4. And they used to think, they were convinced it was going out of business, and they used to tell me that it was the worst investment they ever made. They ended up selling their whole investment at about $4.5 billion.
Yeah, they did okay.
So yeah, they bought it like 200. They put 200 million in, took out $4.5 billion. But they complained like you'd think I chopped their toes off. And then they were complaining about, oh, Fandango, they stink. They don't know what they're doing. And then they sold for like a lot of money. And then when they ran out of things to bitch about, they bitch about Thinkorswim. They'd be like, you guys are even worse than those guys, or maybe just a hair better, but you guys stink too. And then that's the problem with raising money with private equity. They just tell you how horrible you are.
They get a say. They give you money, they get a say.
You have to listen to them, but you don't have to like be nice. You can be like, we were not nice. But I'm just telling you, that's my Fandango story. And
Fandango is owned by NBC Universal. Sorry.
Yes, Comcast owns NBC and owns Fandango now.
Oh, okay. At the time, they were just a small little startup somewhere. I think they were out in California, but I'm not sure. Anyway, all right, boys. Well, tomorrow's. I mean, Chris, you're the master of little.
You're the master of the obvious, Chris. Is what
you're the master. No, you're the master of stock market facts.
Tell us what's happening tomorrow.
Stock market facts. Isn't tomorrow like one of the most historically bullish days of the year?
I rue that you give me that moniker, and yet I actually came with the stats for this unintentionally.
Okay, but of course you did.
Here, before you tell the stats,
okay.
Go ahead. Go ahead first. Then I'm going to tell you a quick little story about what somebody wrote me today.
I have rolling 10-day returns, right? The rolling 10-day return for November 27th is only 0.43%. The best period of the year is October 27th, when the rolling one-day return since 1950 has been 1.99. That comes courtesy of FactSet and Carson Research. So tomorrow's just kind of a day where the market goes up, not really anything.
Somebody wrote me a nice long email today. It was very complimentary. And they said, you know what? I'm a huge fan of Chris Vecchio, but
mistake.
I want to hear you, Tony, and Chris do a segment where the whole segment is just on Vecchio probabilities, probabilistic outcomes according to Chris Vecchio. This guy wants a half hour of discussion about Chris Vecchio's probabilistic outcomes, because he hears us all the time talk about, you got to be better at probabilistic outcomes. And he wants to break down probabilistic outcomes. And I'm like, you know what? I don't hate that idea.
Let's do it.
Not a bad idea.
Listen, second chapter, after you get through ethics, the second chapter in the CFA curriculum is quantitative analysis. So maybe I have a trick or two up my sleeve.
Well, Chris, we will not be doing a show on ethics.
I'm in good standing. I'm in good standing. I'm
you
ethical.
might be in good standing, but the last show you'll ever see on Tasty will be a show on ethics.
All right, my friend. Well, there's the closing
All right, well,
bell.
we used up too much time. Ilya, last word for
Ilya.
For tomorrow.
Nothing.
Tomorrow and Friday, because we won't see you guys.
Nothing's really different. I'm leaning a little bit long the bonds, and I want to sell dollars, but I'm not ready yet. I want to be a little bit long the euro, maybe in the Aussie in the next several days. That's really all I got. I'm still a little short NASDAQ.
Chris, final word.
All-time closing high for the S&P. What's not to love about going into the holidays?
They rallied the bonds here up a little on the close. Hey, if you want to see Ilya, he'll be on Sunday night with me and Victor and Pete Momat. And I know you guys are, you have the show this afternoon, so stay tuned for Chris and Ilya. And then Tony and I'll be back tomorrow morning. Tasty's only morning show only tomorrow. So we're going till 10 o'clock in the morning, and then it's it. We're going dark.
Then we're going food shopping.
We're going to be dark on Friday. The brokerage firm, of course, will be open all day tomorrow. And then, we trade Bitcoin 24/7, and the futures will open back up on Sunday night. But then the futures will also be open all day tomorrow. And then Thursday night, Friday. They're open Thursday night, right, Tony?
Yeah,
they have to be. Yeah. The futures open Thursday night, Thanksgiving night. They'll be open all day. They'll be open Friday to noon, and then reopen Sunday night at 5 o'clock. The show starts at 4:55.
Thank you, Thomas. Great little wrap up. Thank you, Chris. Thank you, Ilya. We'll take a quick 90-second break and come back. Stay tuned, though. You got overtime next. Peace.
S&P closes at a new all-time high. Doesn't mean much of anything. It's Tuesday, November 26, 2024. This, of course, is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco. Dylan Radigan has off today. Quick programming note, we'll be off tomorrow and Thursday as it's time for the holidays. Other than that, welcome to the rest of your trading hour. Futures close at 5 p.m. Eastern, 4 Central. Tell us what you're trading today. What moved these markets for you, what you're doing going into the holiday period. Of course, join us in the Tasty Live YouTube chat or head over to tastylive.com to see what we're all about. Ilya, it was a pretty session. We really didn't cross a significant trading volume amount in either the S&P or the NASDAQ until, well until the afternoon, probably 2:30 p.m. Eastern time. But when the volume comes, as we go to the charts, we can see it's a stock market that doesn't push to a new all-time high on an intraday basis. But the S&P 500 is closing up here at a closing high, both in the futures market and in the cash index. If we were to go over to SPX itself right now at 6021.63, that it is a new all-time closing high here after setting a new all-time high in today's session as well. The tariff man coming to town didn't seem to spook at least these two indexes. NASDAQ up by 0.55%, S&P basically up the same amount. That was more to do in the bonds. If yesterday we had a Besant bounce at the long end of the curve, today that tariff tantrum back in a little bit, but not significantly. The news of Canadian and Mexican tariffs perhaps levied by Donald Trump announced now, which sets up an interesting conversation. Why now as opposed to just applying them when you get on inauguration day? We can try to break that down here. Gold and silver,
I got a theory for you.
As do I. Gold and silver here, they have a very meager bounce after yesterday's bloodletting. Wouldn't really call that a substantial rebound, although when we go through the two, we're going to talk about why these look more toppish than ever before. Crude, of course, stays lower on the back of this Iranian, or rather Hezbollah, I guess it's the same thing, ceasefire agreement with Israel. And, of course, in the world of the U.S. dollar, the dollar reigns supreme because the tariffs tend to do that kind of thing for the gold greenback. Ilya, let's break it down here. It's you and me, so we got plenty of time to kill. We're going to let this decant slowly. We're going to make our way through each little crevice of this market as we wrap up this trading week for at least us here on Overtime. Let's start with stocks, and perhaps even before that. Last night, equity markets fall out of bed 6:30 p.m. Eastern time when we get news that Donald Trump is going to be levying tariffs on Canada and Mexico immediately when he comes into office, with another 10% tariff on Chinese goods. Equities, at least the S&P, spills by about 40 points from where we were shortly after the futures market opened to the lows by 8 p.m. Eastern. And yet by 8 p.m. Eastern, the market has bottomed, and we are now up a healthy 60 points since then. Similar price action in the NASDAQ, different in the Russell and in, of course, the Dow Jones. But why do you think the market is responding at least positively in this particular corner today? Why are stocks shrugging this off?
Well, first of all, we don't have any kind of actionable statement here in the near term. This sounds very much like tariffs as a negotiating instrument, because of course there's nothing to do until late January at the absolute earliest. So this sounds like a pre-announcement of a threat that then becomes fodder for negotiation. As a matter of fact, just yesterday there was a call between the president-elect and Justin Trudeau, the Prime Minister of Canada, which allegedly went well, whatever that means. Justin Trudeau doesn't have much mandate to hold his position, but he remains there, and elections aren't due until well into next year. So we probably have him continue to negotiate with the new Trump administration. But I think also the optics of this announcement are interesting. Yesterday, everybody was clapping and stomping their feet and dancing around in circles after the announcement that Scott Bessent would be nominated for Treasury Secretary. And frankly, there's room for only one star in Trump world, and we know who that is. So when you have everybody all of a sudden going, oh, good, this guy is going to moderate the thing and everything is going to be better now that he's there, he's going to contain impulses. Well, those impulses showed that they were not going to be contained. So I wonder how much of this is the kind of thing we got used to in the first Trump administration, where officials would come out and say things that would make the establishment that worried about greater disruption happy, and then the greater disruption would come back and say, just so we're clear, I'm still here, and I run this thing, and I will not be overshadowed. So maybe that's at least a part of this, but in any case, none of it is actionable until late January. So why worry now? Maybe this is precisely the negotiating tactic that tariffs were meant to be. And over at the former Twitter machine, Bill Ackman, one of the big cheerleaders for the new Trump administration, was trying to actually make this case. He of Pershing Square and Herbalife short fame. He came out and was like, yeah, this is what negotiating with tariffs looks like, everybody. Obviously, this is a hollow threat because there's not the administration in place yet. So maybe we're negotiating already. Okay, maybe.
That's what I shared on Futures Power Hour today. I don't know when Ackman tweeted it out, but the fact that you see Trudeau and Steinbaum coming to the table right away. I have been mixing up names all day today. Mexican president's name is
Claudia Sheinbaum.
Claudia Sheinbaum. I called her Gloria Steinbaum before.
Sheinbaum?
No, Gloria Steinbaum is like not
Gloria Steinem, you mean?
Yeah, exactly. Like my brain is just so. This is like my fourth cup of coffee. Claudia Sheinbaum is the president of Mexico. I said like William Jennings.
That she
Bryan.
is.
Yeah, like I was reading something about Upton Sinclair yesterday after work, and so today William Jennings Bryan was in my head when I was thinking of William McKinley talking about
Dylan
President
did this
Trump.
To us yesterday, name checking William Jennings.
What's his problem,
Brian? I have not heard that name in ages.
And now Dylan's not here, and he gave us these brain worms. Like,
yeah,
very inconsiderate before the holiday. I digress. Okay, so Mexican president has reached out to Donald Trump, although saying that they may implement
it would be,
their own
by the way, a
tariffs.
Hunt brother honorary to name check William Jennings Bryan. By the way,
I suppose that is true. Canadian Prime Minister calling Trump, right? So why do this now? Okay, are the tariffs coming? Maybe. It certainly seems like it. If you listen to Trump, he's made no secret about his desire to implement tariffs as wide as the eye can see. He says, tariffs are the most beautiful thing in the world. He said that tariffs are more beautiful than love itself at one point. I'm not even joking about that. Look it up.
No, he definitely said that.
So this is not an empty threat, right? But why do it now? Why not wait until the end of January when you're inaugurated? You do it now because you want to negotiate. You want them to come to the table and say, look, you got 2 months to solve this. If you guys can make considerable progress with us and work closer with us to get this done, then these tariffs are going to go into place. People may take issue with that negotiating tactic. I understand, but this is just where we are. And the results, at least from the communications we've heard, are a market that says, hey, at least as it pertains to stocks, at least the S&P and the NASDAQ, what's to be worried about? This is, he's talking tough, but maybe they won't actually get implemented. And I think that's also the read-through on bonds here over the course of the day, because they did fall off last night, but we see a broader recovery here. It wasn't that terrible last night coming out of the session, okay? And then we think about today's price action, we didn't really get crushed or move lower here. I think that substantiates our longer-term view that, for the most part, a lot of the price action that we were looking at in the month of October, that was the market pricing in these tariffs, pricing in the higher probability of that structural inflation moving forward. And so when the announcement comes out, it's kind of like, well, yeah, we know that that's what we've been doing since the middle of September. We've been talking about that if Trump is more likely to be president, then the tariff threat means higher inflation expectations embedded in the economy. And so when you get this tariff threat last night, bonds basically go, yeah, we know.
Yeah.
So that's right. I don't know how much of this isn't already discounted in the market. So as just a case in point, we ran through this exercise on Futures Power Hour today. Ilya, off the top of your head, do you know how much the S&P 500 was up during Donald Trump's first term?
I don't, actually. I think overall, if you take COVID out of it, because that wouldn't be fair.
No, keep COVID in.
Oh, keep COVID in? Oh, it was down a lot. It was down double digits.
Oh, no, not just 2020. So 2017 until from inauguration until he goes out, it's up about 60%.
Nearly flat, I would say.
No. S&P's up nearly 60% during Trump's term.
Oh, really?
Despite
including
COVID. Including COVID. Doesn't really matter, the tariffs, right? What's the S&P 500 up right now during Biden's term?
Sure.
Believe it or not, it's up within a tenth of percent, the same exact amount as it was during Trump's term. And the Biden administration has by and large continued these tariffs that the Trump administration laid down in the first place. I mean, look at what the China tariffs have done in recent years. They've stayed. And that's why the amount of goods that we as a country import from China in terms of the composition of our total imports has fallen from about 22-23% pre-trade war in 2018, 2019 to where we are today, which is more like 13-14%. And that puts China on par with the same level of imports that we bring in from Canada and Mexico. But the point of all that is that outside of the headline risk of the immediate market reaction last night to, oh, this is a scary headline happening during a liquid trading hours, the market bounced back fairly easily over the course of the session. And so if this is seen and these tariffs are being used as negotiating, which the opening salvo appears to be a negotiating tactic, I don't know if we can really put too much stock in the short term for these tariff headlines to be anything other than temporarily disruptive, because they have been priced into such a large degree.
Yeah, I mean, it sounds like the same sort of thing that I've been talking about with you and on Macro Money over the past several days. So Friday, yesterday, around this idea that, yeah, the tariffs are reflationary. Yes, what the Fed is doing, the markets were already judging as reflationary even before the election. And we'll get to the FOMC minutes in a moment, I'm sure, which came out today. But the market already voted that way in early September, basically saying the Fed is going to cut by a lot. They're going to promise a lot of easing. The economy is not cool. This is going to be reflation. Bonds start to fall off mid-September, right after the Fed cuts rates by 50 basis points. Yields start to surge. The dollar starts to surge. The question for me increasingly over the recent days is, yeah, okay, we've known this for 2 months. At what point do you run out of speculative juice in the near-term story because there's no more immediate fodder? Now we need something like the December FOMC announcement with the updated SEP to tell us where the Fed's head is at as far as rate cuts for next year, because the markets have significantly diluted that outlook. The Fed said 100 basis points in September. The market is now barely over 50, and the markets were at 125 when the Fed said it. So the Fed ended up looking a little bit more hawkish than the markets in September. Now the markets look a lot more hawkish than that same Fed baseline. So that's an open question. We have an assorted bit of economic data like NFP, CPI for December. That should be interesting. But there's not really anything new in the near term. The election is over, and we have a bunch of yelling and a bunch of headlines, but there's not really anything that's practical policy until January. So the question increasingly for me is, have the markets already accounted for and discounted everything that there is to discount, at least for now? And does that then mean bonds look cheap and the dollar looks expensive? And then what does that mean for stocks, which on the whole are struggling to do much of anything for weeks now? If you look at where stocks are, even just on the S&P, yes, it's a nominal record close today. We're still not over the election high. We've basically gone nowhere since the election bounce peaked. It's the same in NASDAQ. And if you look at what's going on in the Russell, it basically ran into a wall at its mid-November high. So at this point, the risk there seems to be a correction the other way because, again, everything's in the market. So it's really not surprising in my mind that this got shrugged off, because it's just yet another sort of episodic thing in an otherwise pretty well-priced range of macro assets. And the trigger now may be actually in the other direction, just because speculative interest comes out across the whole board.
The FOMC minutes may have helped clarify the Fed's intention for what they're going to do moving forward.
A little bit, yeah.
Today, we got those minutes out, and in the course of the minutes, we can see that the Fed says, in discussing the outlook for monetary policy, participants anticipated that if the data came in about as expected, with inflation continuing to move down sustainably to 2% and the economy remaining near maximum employment, it would likely be appropriate to move gradually toward a more neutral stance of policy over time. And that is enough to see the market price in a 63.1% chance of a 25 basis point rate cut next month. A considerable swing from where we were yesterday, up from 52.3%. And so it looks like that the Fed is going to give us that December cut if the minutes are accurate. And that, of course, is contingent upon what we see with not just some of tomorrow's data between the durable goods, PCE, personal income and spending, GDP revision, right? We are going to have the non-farm payrolls next Friday, and then we're going to have the CPI the week after. But this is perhaps one of the signs of relief right now in the market in the short term. It's not going to be, well, maybe we don't get a December cut and we'll see if they give it to us in January. It's okay, they're going to give us one more. And then the question is, how many more do they give us next year? Because the market has two more discounted through the middle of next year, one of which would be the one for next month. So that leaves you in a situation where, okay, this next set of this projections that the Fed's going to give us, thinking about these new FOMC minutes, they could very well tell us that the cycle is done come March. And then you have a 6 to 9 month window, and we start to look at the future interest rate expectations out into 2026 to 2027, then the longer run. And we have to at least consider the fact that they're going to be putting in some rate hikes on that schedule if the economy is expected to be stronger than, well, where we've been.
Yeah, I mean, if you look at the way that these minutes are structured, right, the Fed will give you a sense of conviction by saying, you know, a few people said this, many said this, several said that. And the two things that really jump out at me is, the first is almost all, underline, almost all participants judged that though month-to-month movements would remain volatile, Incoming data generally remained consistent, with inflation returning sustainably to 2%. So this is not a Fed that's going to get off the dovish side of the spectrum. They may calibrate how much, but for now, we're still in cutting mode. And then the second one was a large majority, again, bold, underline, large majority, of respondents had a modal expectation of a 25 basis point cut at this meeting, that is November, and another 25 basis point cut at the December meeting. Not surprisingly, the odds go up. So the Fed is signaling here, and the hawk of hawks, Michelle Bowman, voted for the consensus view in November. The path of least resistance is basically the Fed told you in September what they're going to do, and you and I have talked about this. They basically talked themselves into cuts in November and December. They gave you a forecast of 100 basis points, of which they delivered 50 in September with 2 meetings left. And when Powell was asked at the press conference following the September meeting, so what should we expect next? He goes, yeah, look at the SEP, which he never does. Usually he says, the SEP, who knows? People pencil things in. It's practically not even there. What are you even looking at? This time he was like, yeah, look at the number. There's the number. And that was out of character and suggested that the Fed was pretty confident that they're going to have to do these follow-on 50 basis points in one half in November, one half in December. And the market, understandably, is tilting that way after the minutes basically confirmed that. But this is status quo. This doesn't change anything.
You know, you talk about the Fed vernacular because they go through a few different iterations of things. Some, a few, many, most, a substantial majority, most everyone, right? And so it's like, okay, so there's 2, then there's 3 to 4, then 4 to 5, then 7 to 8, 8 to 10, 11, 9 to 11, and then I guess 11. Anyway, the vernacular breakdown, it gives you the shape of when you delve into the meanings of the words and how they've deployed them previously. If there are 12 FOMC officials, right? Okay, this is how many are voting or thinking in this direction just by that particular word choice. But I think when we look at those minutes today, that's why there is a shift where people feel like there's a little bit more that can be done. And then perhaps it's worth taking a pause to see where we sit and write things out for a while. And then that really leaves open the door that the cut cycle actually could be finished as soon as next month. Because if the Fed says they're not going to cut in January and then we're waiting for them to come back in March, tariffs could be in place by then. We could see, you know, what the implications are to the economy. Does that mean structurally higher inflation? Is that famous double peak inflation chart, or I suppose for the viewer, right? Is that going to make a comeback? Because, hey, that was right the entire time. And then Powell looks more like an Arthur Burns than a Paul Volcker along the way. Who knows? For now, though, the path seems to be set. So we're heading into a holiday shortened week where tomorrow you and I are not on air. I'm planning on doing absolutely zero trading tomorrow or on Friday unless, well, okay. You know, I'm about to say that, but then it's like, unless one of these things happens, which means I have my watch.
Unless something happens.
Unless the thing that I'm hoping happens to get me into a trade happens, I'm not trading, which is the same thing every single day. So I guess I'm trading normally tomorrow and Friday.
Right.
We look at this market distribution today. We look at 25 ETFs here. Track those on Futures Power Hour. 3, 6, 9, 10, 11 are in the green today, led higher by XLU. Those utility stocks continuing to charge up to a new all-time high. This has very much been part of the AI story and the significant power demand story that we've seen here in the U.S. One of the facets that pushes money into these areas is, will they face competition? Utilities are heavily regulated in the United States. They can't really make much more money unless there's significant demand for what's going on here. And the reality is that there is just, for what's coming with AI, we don't have the data centers, we don't have the power sources, we don't have the transmission lines right now. And so these companies are just, they're printing cash. I believe it was last week that we talked about a report from the state of Georgia where they issued their data center expectations, or at least their power expectations, through 2034. For their power load forecast, I just pulled it up here. Georgia's power load forecast into the mid-2030s by source of demand. Green tech is going to demand 1 gigawatt. Manufacturing is going to demand 1.2. Everything else is going to demand 1.2 gigawatts. Data centers in the state of Georgia will command 31 gigawatts of power. So these companies are on fairly strong footing right now. We've obviously what's been happening with natural gas prices, utilities up here. Outside of that, nothing else gains more than 1%. There are several ETFs that lose more than 1%. Regional banks are down 1.07. OIH is down 1.14. Yesterday's big gainer, XRT, is off by 1.51. Should be 1.54. XHB, the home builders, down 1.91, and home construction down 2.11. Ilya, that's where I want to get you focused, because that new home sales report today was something fairly shocking. New home sales down 17.3% month over month, excuse me, which is one of the largest drop-offs that we've seen, not just in recent history, lowest since March 2013, but it's one of the lowest that we've seen over the past 70 years. It's the 8th biggest contraction since the housing series began. Is that something that we should be worried about?
I mean, nominally, yes, of course. And what I think really pops out here, new home sales are not a big part, relatively speaking, of the housing market. Most U.S. inventory is existing home sales. In fact, the spread is about 4-to-1, existing homes to new homes. So, and this should really speak to the ridiculous shortage of housing in the U.S., of new construction, and how much of the prices being as high as they are in a lot of places is a function of just inadequate supply and inadequate building. But I digress. The drop is, of course, notable. It is a volatile series. I mean, as recently as, let's say, August of 2022, you've had spikes as big as 24%. In June of 2020, amid COVID, spike of 26%. In June of 2022, a decline of 16%. So all of this is to say, this is a volatile series. It can have really big swings. And it would be probably less than ideal to assume that what you're seeing is necessarily indicative of a trend or something along those lines, even though this was the biggest decline, as you just mentioned, since 2013, when we had a monthly decline of 20.2%. So it's a big number. It's a scary number. It's outside of the kind of range of values for a while. I don't think we can really hang our hat on it yet. And anyway, this is something to watch, because just earlier today, there was some numbers that were reposted by Kobalesi that showed that auto loan delinquencies are rising to fairly scary levels here, and loans in serious delinquency are rising to fairly scary levels, levels that really are unseen in quite a while. I'll just pull up the reference here. The delinquency rate in the third quarter of 2024, 8.1%, which also, interestingly, is the highest in 13 years, and serious delinquency, 2.9%, the highest in 14 years. That's the worst since we've seen since 2009, amid the rubble that was the Great Recession and the global financial crisis. So does the new home sales thing tell you something singularly bad. Well, maybe not. Again, it's a volatile series. But when you start to put some of these things together, rising credit card delinquencies, rising auto loan delinquencies, a drop off in new home sales, which tend to be the kind of thing where people upmarket are moving the needle, especially since mortgage rates are still as high as they are. And of course, new homes are scarce and therefore relatively expensive. All of this starts to paint for you a picture of a U.S. consumer that might be getting a little exhausted. It might be starting to creak under the sort of collective weight of everything. Now, does that ultimately start to roll over because a lot of this stuff is lagged? And actually, we've seen months now of wage growth outpacing inflation. And so one would think that consumers' purchasing power should be increasing? Or is this telling you that they're basically blowing that increase in purchasing power? We just saw retail sales numbers were very strong. Are they just buying stuff and not paying down loans? Is this getting us into an issue similar to what happened at the onset of the 06, 07 issues that later became the housing crisis? I would say watch this space. It's not anything that's a ringing alarm right now, and you're seeing that it's not in markets because they're sort of looking at this with some level of disconnect and just basically going, yeah, big number, okay. Stocks didn't move on it much, dollar didn't move on it much, yields didn't move on it much, but this is a place to watch because the pile of evidence suggesting U.S. consumers, especially upmarket, are starting to get a little bit stingier with the incremental dollar and a little bit more hampered. That's starting to accumulate. And there will be a point where it accumulates to a breaking point. It's just not yet.
When I think about the housing data, I went through the series today, and I can't help but think maybe it's regional weakness related to the hurricanes.
It could be.
The month-over-month change here, for example, nationwide is minus 17.3%. For the Northeast, wow, 53.3% increase in home sales, but it's 34,000 units, excuse me, it's 46,000 units, an increase over the 30K that were sold in September. That's not the biggest housing market in the country. The biggest housing market in the country is the South right now. And the South saw 339,000 units sold from 469,000 units in September. That's a 27.7% increase. Year over year, it's down 19.7%. What did we have that swept through the Florida, Georgia, North Carolina area that has all this housing growth? The new home sales, Hurricanes Milton and Helene. So if we were to back this out, you know, we think about how the Northeast grew, how the Midwest grew, how there was a slight contraction in the West, you know, minus 15 here, plus 1 there, plus 16 here. Outside of what we saw in the South, net, there were actually like 3,000 more new home sales in the Northeast, Midwest, and Western regions cumulatively. Mm-hmm. So I look at the data today and I see this big pullback in home builders because of this new home construction report. I don't know. That doesn't seem like this is something sustainable in the short term. It seems like there is a really unique, really idiosyncratic reason for why homes were not sold last month in a portion of the country that was ravaged by 2 hurricanes over the span of a week. I obviously like home builders. I have some activity going on in ITB. The supply-demand argument here is convincing enough. The biggest risk to this position, to my home builders argument, is quite frankly the tariffs. Because if you're getting rid of, and I have the numbers on this here, part of the data series I was looking into last night, for the construction industry, estimates suggest that 13.4% of the construction industry share of employed workers who are likely unauthorized immigrants, and then for construction, 25.7% share of employed workers who are immigrants. So if you're doing a big deportation scheme that goes beyond just, you know, to what Honan and other Trump advisors have said they plan on doing, that could be a significant labor disruption for home construction. And likewise, if there are tariffs, it could be significant disruption on the supplies needed to build the homes. And so it doesn't really matter if we have a situation where there's a lack of supply in the country. There's literally not going to be the materials around to produce the homes at the cost and scale that's feasible to resolve the shortage problems that we're looking at nationwide. I really like the conceptual idea of being long home builders. I think this report was a one-off today, but there is that tariff overhang that we just can't ignore right now. So I'm going to look to try to add on this first dip back towards 120 or so and scale into a position, looking for a turn back to 130 in the short term. But if we can't get back there before the end of the year, I would not be comfortable holding this in going into 2025 as these risks become less of something that are on the event horizon and they begin to move up closer to present day.
Well, and there's significant risk even beyond the labor disruption. I mean, one interesting thing about this announcement of preemptive threatening of Canada, say, everybody likes to talk about Canada's exports of oil. Canada exports a ton of lumber, which for the housing industry is a huge input, especially in the U.S. So these things have multivariate and multi-pronged impacts. Yes, when you look at the overall performance of the S&P over the Trump administration version 1, you don't see lasting influence, but that's also because last go around, you had a renegotiation of NAFTA into USMCA, which I guess you could argue, and I've seen the argument put out there that it's a little bit more U.S. advantageous than NAFTA was, but the differences are not significant from my perspective. I mean, when you look at it, these are very, very similar things. So, and the deal was done with relative speed. So, as far as at least trade negotiations are concerned. So, when you look at this, yeah, okay, maybe this wasn't a significant thing last time, but also Justin Trudeau was not a lame duck prime minister last time. It's unclear what the outcome would be this time were we to actually go to something that drastic. And of course, when you have a situation where two countries that ostensibly have a trade agreement, a free trade agreement in place, and now you're saying, we're going to apply tariffs, that actually has a very significant chilling effect, because not only does it tell you that, there's going to be tariffs, that much we know, that there's going to be tariffs on countries with which there is already a trade agreement. That tells you nobody is safe and trade agreements don't mean anything. And that can introduce a level of de-risking from U.S. Overseas suppliers that basically just introduce a premium into the price of things and go, you know what, maybe there's not tariffs hitting, let's say, European aluminum or steel now, but we need to be ready. And so we're just going to build in the extra risk premium into the price now. That can have a chilling effect on input costs for the construction industry as well as all kinds of industries before even tariffs arrive. So it's a significant risk. I don't have any exposure here at this point, and if I did, it would be longer term. I do think that there's an attraction in the builders because the U.S. is woefully undersupplied, and that's becoming increasingly a consensus view. But the pathway for how this gets resolved under a Trump administration is probably through the deregulation and tax incentive path, rather than through the creation of demand by essentially mandating the building of homes. So and obviously economic incentives to make that viable, which was in the Harris-Walz proposals. So this version of it might well be less impactful, while the flip side, the disruption of inputs through tariffs, through all manner of labor market shenanigans, if there were a mass deportation, that actually looks like the bigger risk. So I'm circumspect here. I would like to see what all of this actually looks like before diving in. And it's helpful that all of it is sitting in essentially a range and near the middle of a range. So if you wanted to take a longer term view, you could essentially back up and say, you know, here's a monthly chart, here's a weekly chart. Here's how I would lay on longer term kind of thematic exposure. I have plenty of time to see what things look like because I'm not on a, let's say, 45 DTE cycle on something like this.
Ilya, semiconductors have been struggling here the past few sessions. SMH continues to slouch back. Are we, you know, a lot of our focus geopolitically has been on what's happening with the Middle East.
Yes.
It feels like most of the tension in the Trump administration's first term was more about the Korean Peninsula. And you know, he obviously had a very good relationship with Shinzo Abe, but it was really about South Korea, North Korea, and then China, Taiwan. Because once you had the Abraham Accords in place outside of the IRGC commander who was killed, Qasemi, right? Soleimani.
Qasem Soleimani.
Qasem Soleimani, right? Then, you know, there really wasn't that kind of tension in the Middle East world. I know that we can run through the numbers about the number of drone strikes that they did in the Trump administration, all that stuff, and there's all kind of operations still going on, of course. All right. But in terms of like sovereign geopolitical risk, that was more war on terror operation theater still.
Sure.
Because they had to get, you know, Baghdadi and whatnot. In any event, it feels like we're maybe under, you know, not considering the China-Taiwan risk here at all. It feels like it's been somewhat of an understanding that China really doesn't want to invade Taiwan. Trump, however, is always to cut a deal. Are you enamored, concerned by the fact that semiconductors, which have been such an integral part of the rally this year, they are really not participating? Or, you know, can we try to silver lining this? Stocks are continuing to go up even without semiconductors. This is a broadening conversation now. So that's good. Which way do you look at it as we literally rest upon the knife's edge of the 50% mark of the 6-month trading range, as well as what we would say to be the uptrend from the August and now initial November swing lows?
Well, I think that you've painted the argument exactly, right? One side of the argument would be everybody hated the tech-driven rally because it was so concentrated, because it was so one-sided, and everybody said, well, there's no breadth in this. This is just a bunch of excitement around AI. Everything else is lackluster. This rally sucks. Now everybody is looking at this and going, well, look, the leaders are flagging, but of course, the bullish perspective, and it's a very reasonable perspective, is you all hated the concentration. Now the concentration is dispersing and other parts of the market are catching up as there is rotation. You can't hate both things. You have to like
pick a lane. Pick a lane.
Yeah, you gotta decide what you want to do here. And a perma bear, I am not. So I look at this neutrally and say, well, yeah, this looks like rotation. And in fact, the tech side has been underperforming since July. NASDAQ still hasn't set new highs. If we look at the tradable instruments since topping in July. That's why this is the only one I still have short. So off the high, basically saying that's a top. And then we'll see. But this is a story that's been here for a while. This is not new. The interesting thing for me, though, is yes, there's dispersion. Yes, there's rebalancing, without question. Nevertheless, NVIDIA is still the most valuable company, last I checked, in the world. And by a long mile. The weight of tech in these benchmarks is still ridiculously high. And that doesn't mean that the market is going to go down just because things are still concentrated, albeit less so. Because obviously it can keep going as long as it wants to keep going and not a tick shorter. So that's not a bearish argument unto itself. What it suggests is that if finally there is a round of profit taking on tech, it will not leave the rest of the market unscathed. There will not be decoupling. What this rotation doesn't mean is that if the AI story goes the way of every single other story like this, be it telecoms in 2000 or railroads at the turn of the century or the North Sea bubble or tulips, you name it. You name it. Tulips, that one's not fair. That wasn't a breakthrough technology. But telecoms were, and railroads were, and they were transformational and changed the economic reality of humanity forevermore after their introduction. None of which changes that every single time you get one of these things, there is a hype cycle, then a massive letting out of steam, and then the longer term narrative. Once you burn through all of the shenanigans, all of the coulda, shoulda, woulda, and frankly, all of the initial graft. So tech will experience this again, if history is any indication, because it's happened every other time. And when it does, the larger indices will not go unscathed just because there's been some rotation. When there is a panic in something that is this significant, correlations go to 1. Everybody's going to sell everything that's not nailed down. So, yes, this is good to prolong pulling on the rubber band, and it can continue. There's nothing to say that it can't. But it also doesn't insure anyone. It's not like tech is going to go into a corner, have its shakeout, and then everybody else is going to la-di-da their way higher. No, that's not how this is going to go. Also, as a completely random aside, apropos of nothing, as we were talking about returns for Trump's first term, it became a gain of any amount of anything. Basically in April of 2020, and it reclaimed its pre-COVID high hilariously in November of 2020. So COVID basically shaved 3 years of gains off the market, and then thank you, Fed, for your expansive easing. The market found
the easing and the stimmy checks, and then the vaccine announcement the week after the 2020 election. Yeah, I mean that was just what the market needed to get going. That was
all
that
of the gains basically happened in 3 months.
That was a crazy week. I remember when the Pfizer results were announced, and it was just wow.
I was looking back. I'm like, no. I'm like 60% where? And then I look back, I'm like, oh yeah, the last quarter. It all happened in the last quarter.
Yeah, well, it's still counts, right? It may be, as they say in sports, at garbage time. But
it counts. I'm just not sure.
My team still accepts points in garbage time, right? Like I want my guys running up the score. Ilya,
no, it counts. I'm just not sure it represents resilience to tariffs.
When we and that is one of the considerations, right? Like May 2019, the China tariffs are announced, and by the time the teeth really start to like sink in, we go into the pandemic, and so much of like the supply chain disruption papers over a lot of the tariff disruption, even if there was people will say is it was a one-time 20% price increase for like the washers and dryers. Yes. And the only reason why inflation subsided after that is because all other household item categories actually saw lower prices, and washing machines and related goods continue to go up. But I want to switch the conversation here. Last 5 minutes.
Yes.
We're going to hear plenty from me today and you today. You're on Macro Money. I'm with Victor on the Price of Truth. So let's not waste all the votes in the chamber. Bitcoin here down another 3.2%. Ethereum down 5.61. Ether has become a walking meme at this point. Right. I saw a great meme yesterday. Like the only thing worse than not being long Bitcoin is having been long Ethereum. Like, right. Like forget missing the rally in Bitcoin. Right. That's actually not the worst thing. The worst thing is owning Ethereum. So Ethereum continues to do whatever it's doing, but Bitcoin's now down to 92,820. In the futures market, we did briefly cross 100K in the past 48 hours, 72 hours here. Is this the top? I don't want to say is this the top, but I'm going to ask the question anyway. Does this feel toppy, technically speaking? That is a more an evening star with nice follow through today.
Yes. Yeah.
I mean, not that affects me because I'm still going to do the same thing I always do, which is just sit on my hands.
Yeah. I mean, I have zero exposure here, so I'm going to obviously talk from the perspective of just analyzing this market rather than trading this market, because I have no exposure to crypto whatsoever. And that's just a philosophical decision. That's not because I currently don't have any or I don't have any yet. For me, crypto is a conversation about a technology that will be used to improve payments systems within traditional fiat land, and what that will look like is a disruption to the banks rather than crypto being something that disrupts national currencies, which I know is what the maximalists think it's going to do. Godspeed on that. Find me a government that's ever given up the power to issue the coin of the land, and then we can have a conversation. But in the meantime, we look at a chart like this, and I think first and foremost, we have to start taking crypto tech, that is to say technical analysis of crypto, seriously.
Oh, yeah.
Before,
of course.
Before, you could very easily write it off and say, this illiquid thing, what do technical patterns on this mean? They mean nothing.
I think technicals have worked great for a long time in crypto, only because, like, what else do you have? What else do you have?
You have nothing.
So a lot of people become self-fulfilling. Like a lot of people are then analyzing the market in the same way because there are flaws with looking at the number of nodes in use or on-chain analysis. I look at Glassnode all the time, and having done backtests, is there really anything there? Like, you know what? Right. The fundamentals, we can talk about the fundamentals. We can try to construct fundamentals for crypto. The technicals just work fine. The technicals they've been great. So why deviate?
Well, so right. Anyhow, and then the other argument is crypto is near impossible to short until recently. So is the technical analysis actually meaningful? Because what is it being driven by? First of all, the idea that crypto is decentralized has got to be the biggest joke in crypto land, because most Bitcoin, for example, is owned by a very small handful of early buyers. So it's actually very centralized, much more centralized than, let's say, an emerging market currency, let's say from Africa. It is overwhelmingly centralized, actually. And everything else is kind of chipping around at the margins. But nevertheless, it's had a big inflow of liquidity, and now maybe you have some two-way action. Because most crypto ownership is never selling. It's all hodl. And most of it is in but a few maximalists' hands. So it's not the kind of market that has strong two-way action. So can you really take bearish signals seriously? I think increasingly, yes. Because increasingly there are tradable ways. For example, options on the ETFs give you a way to do something. They're not great, but they're building. And the introduction of the ETFs is introducing more liquidity and ostensibly more two-way action. So when you see an evening star like this with confirmation, whereas before maybe you would look at this and go, yeah, that's cute. Now I think you actually have to take it seriously. Having said that, we're sitting directly on what would be the previous level of near-term support. You can see where that preceding red candle is. That establishes a kind of horizontal level that we're basically sitting on now. So do we have confirmation of a break? In the traditional technical analysis sense, I would say not quite yet. And if you did see a break, would you want to short it? That depends on whether you have deep enough pockets to structure a trade. I don't, because the costs are still astronomically high just to take a 45-day DTE kind of a bet that you want to live manage. So for me, this doesn't mean much of anything yet, but if you wanted to allocate, you could. You would just need more confirmation.
Just looking at the short call spreads in the BTC futures, just going $1,000 wide, the buying power is going to be around 6,000. That might be a little bit disadvantageous for people who are trying to play the options market here. But then if you go to IBIT, right, we're talking about very small buying power. Short call spread, $1 wide is going to be $56 total. So that, again, product availability is going to help drive interest in the space. But the pullback that we've seen here and the fact that Jim Cramer 2 days ago was talking up Bitcoin probably was the high. But we'll have to talk about that next week because overtime is out of time for today and the rest of this week. It's Thanksgiving. So hope you have a good one with your families, friends. And if you don't celebrate, then just enjoy not seeing us, I suppose. But we'll be back next Monday. Same time, same place, after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak, I've been Chris Vecchio, and for our third compadre, Dylan Radigan, we wish you a good rest of the week trading. After a brief break, Ilya is back with Macro Money. I'm around later with Victor for the Price of Truth. So be sure to stick around. Tasty at Night coming up next.
See you there, folks. It is starting to wind down. This is, of course, a holiday-shortened week for financial markets, and you see it in the price action. Stocks wiggle back and forth a little bit, but ultimately don't go anywhere. The dollar wiggles back and forth a little bit and ultimately doesn't go anywhere. Bonds wiggle back and forth a little bit and ultimately don't go anywhere. So, as liquidity starts to ebb, we're going to look further afield for what comes after the holidays. We focused on the euro yesterday here, and today we're going to take a look at China. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And what we're going to do is, having already looked at what's coming up with the FOMC minutes and the PCE data out of the U.S. tomorrow, obviously FOMC minutes already out today, and as expected, no big changes, no big market moving insights there. Yesterday, as I just mentioned, we looked further ahead to Eurozone CPI data that is coming up later in the week. But even after that, coming up for release this weekend is some critical economic activity data out of China. And it presents an interesting point of conversation because China has been an absolute basket case economically, and it bears wondering whether at some point, as markets do, they will have discounted all of the bad news and bargain hunting can commence. Now, this is a question that's been asked with quite a bit of enthusiasm this year. Obviously, we've seen Chinese stocks surge, then drop, then surge, then drop around stimulus expectations, which ultimately were let down. And so it's a conversation that's been had and that's fizzled. But perhaps now we finally have something to hang our hat on. And this is where we are going to begin the conversation here. Let's assess, why is it that China has been so woefully weak? What's been going on, and whether the markets are finally done introducing the level of woe into asset prices, which of course then makes those assets attractive from a speculative perspective. The goal, after all, isn't to buy expensive, it is to buy cheap. And cheap means that things are suffering, there's lots of pain, and nobody wants this. Which, of course, if you're looking for bargains, is exactly what you want. So, let's consider first and foremost the nature of the beast in China. And we'll go through this step by step so that we can clearly see what's going on. This is a chart of Chinese GDP growth. The red line is real GDP. The yellow line is nominal GDP. And in the bars is the spread between the two. The critical bit here is to notice that over the past 6 quarters, right here, so basically from the beginning of 2023 onward, what you have is a situation where China is seeing real GDP growth in the red here that is outpacing nominal GDP growth. In fact, the only quarter where you get a little bit of a pop is the fourth quarter of 2022 into the first quarter of 2023. It sort of shows up right here. And where you get that is, of course, the jettisoning in China of zero COVID restrictions. But you can see that already going into the tail end of 2021, where real GDP is running below nominal, and indeed everything is surging as we come out of COVID, this spread starts narrowing and narrowing and narrowing and narrowing, and already into the fourth quarter turns slightly negative, then rebounds. But this state of affairs is where we are currently. And this is actually an incredibly damning chart. Here's why. Real GDP is supposed to be the actual value of the goods and services produced in the economy minus the influence of inflation. So when you add up all of the value, you then take out inflation to say, well, the value would be inflated higher than it would normally look. Were you to include inflation, let's take inflation out to give us a real sense of how much the economy, quote unquote, the real economy, is growing. That nominal bit that includes inflation is nominal GDP growth. That's the yellow line there. So just on the basis of first or second grade arithmetic, if nominal GDP includes inflation, then real GDP is nominal minus inflation. And if real is above nominal, then that inflation coefficient is negative. The only way you get to nominal GDP being below real GDP growth is if inflation is negative, and so nominal minus inflation is a larger number. And the only way you do that is if you subtract from nominal a negative inflation coefficient, which tells you there is economy-wide deflation in China for the past 6 quarters. Now, what does that mean? Well, normally, if there's demand for goods and services, obviously there's a finite amount of them available for consumption at any given time, more is always made. When there's growth, then the amount of goods and services made grows. That's what GDP growth is. But at any given moment, there's a finite amount that's ready to be consumed at every level. So if there's growth in demand, that growth in demand gives you positive inflation as people, businesses, entities, institutions, you name it, compete for the available supply of stuff. And of course, the only way they can compete is on the price. Whoever is going to pay is going to get the stuff. So under normal conditions, if there is demand, there is positive inflation. If there's not positive inflation, essentially the entire economy has been relegated to the bargain bin. It is on discount. The only reason why prices would be getting slashed is if there's not demand at the price, and prices need to be slashed to try to get that demand to happen. And for 6 consecutive quarters, it's not happening. The negative quotient is changing from quarter to quarter, but nevertheless, the negative quotient persists, which tells you we haven't discounted enough yet because there is no demand in China's economy to speak of. Now, they've attempted to fight this issue with ever-escalating bits of monetary stimulus. They've cut interest rates. They've reduced banks' reserve requirement ratios to make more capital available to be lent out and to make that lending cheaper. They've moved to let municipal governments work down their debts so they can spend more. They've introduced direct capital injections into financial markets, including outright purchases of stock to try to get more money in the hands of corporates and try to boost sentiment. They've tried all manner of things to uplift the flagging housing market, which is the main investment destination for the Chinese population, to try to get consumer confidence rebuilt so that people buy stuff. None of it's worked. In fact, a survey from the People's Bank of China recently showed that household bank deposits are at a record. Basically tells you people are just hoarding the money. They're not spending it. And so what you see here as a kind of catch-all indicator is the Bloomberg Credit Impulse Index for China. And all this does is measure the share of new loans in GDP. And what you see here is we are at the weakest that we've been since 2018 overall. That's the red line of the index. But the growth rate is actually even more staggering because, as you can see, the yellow bars, the year-on-year bars, they're negative and getting more negative. So as of October, the share of new loans in GDP fell by a whopping 14.5% year on year, which would be the fastest contraction since February of 2022, the heart of COVID. So the very generous monetary largesse that has been heaped upon the Chinese economy is very plainly failing to do anything about the woeful demand.